Shall we get started? All right, well, day 2 of our February meeting, February 12th. And we'll begin the meeting with roll call, please.
Carl England.
Here.
Mark Nonig.
Here.
Jack Prothero.
Here.
Terry Cohey.
Here.
Bruce Nelson.
Here.
Diane Fladmo. Maggie Peterson. Here. Jeff Greenfield.
Here.
Virginia Edwards.
Here.
Senator Thomas.
Here.
And Representative Hamilton.
Here. All right. Please remember that we are, that the video is on and the audio is on. So silence your phones.
Perfect timing. You know, that caused some donuts in the legislature.
It does. Over here, though, it's muffins.
Any public comments on issues within the board's jurisdiction? If not, we'll move to tab 7. Michael, private investments, new commitments.
Morning, everyone. Made a commitment late last year to Senate Capital Partners Fund 3. This is a China-focused manager buyout for growth investment. Been tracking them for a while. Met with them multiple times in 2018, 2019. Pedigree Group, they came from JP Morgan, ran the China advisory practice there, so very institutional background. Then they went to run D.E. Shaw's, one of the largest hedge funds, ran their China PE business. They left D.E. Shaw through the GFC and the Great Financial Crisis. They just weren't doing a lot of China-based deals because the greater hedge fund was in, had a lot of drawdowns, and so the group spun out and started Ascendant.
So I always like to understand their investment philosophy or what they're really investing in. So could you describe like what investments in growth sectors are? I mean, little detail.
Yeah, I would say Ascendant at a very high level is focused on upgrade consumption of the middle class of China, and that's people focusing more on education for their children. It's an interesting dynamic with the one-child policy. So a lot of these households have 4 grandparents, 2 parents, 1 child. And so, it's essentially the golden child. And so, the future, the prestige of that family is around this child. And so a lot of money is spent on education for this child. So that's one example or thematic approach. Another is healthcare. It's a growing elderly generation of the grandparents. And so healthcare has been a growing focus for China investments in general. Another one is millennial spending and technology. I was in China. I went to a coffee shop. I couldn't pay with cash, and I didn't have the app because I didn't have the Chinese apps. So I couldn't buy a coffee. And that's one of China's largest coffee chains. I mean, it's on par with Starbucks in China. That's how far their technology has really risen in China. And so that's going to focus on these, high-level themes. But I would say in general they are more of a value investor rather than just pure growth, which you would think most China's investors are. They're very sensitive to valuations. They've been buying multiples lower than market multiples. China multiples have been very high compared to the U.S., but I think Ascendant is cognizant of buying on value and not just riding momentum. They've been doing this for a while. I think they've learned some lessons through the GFC cycle, things like that. So I think that's why we like them. Their track record is very good. They've done 15 deals in the Ascendant platform, 0 losses, good track record.
Mike, I've got 2 questions for you. One, did somebody else in the coffee shop buy you coffee?
No, I left and went somewhere. I was so embarrassed. Like,
Trying to gauge the friendliness of the thing. Second question is, in a private equity situation like this, is it like a venture capital fund where we wait for capital calls to give them money, or do we just write the check and give them all the money on?
it'd be through capital costs. And so they'll draw down as they make investments over time. And just on your comment earlier, I was surprised when I went to Shanghai. It was my first time in 2019. Very friendly, surprisingly more so than other Asian countries I've been to. Very clean. When you walk around, you don't hear any taxis honking their horns. No one is speeding, and I think that's partly due to the top-down government making sure it's a friendly experience for international travelers. So I had a very nice time, very friendly people in Shanghai.
I have a question. This limited partner membership, yes, but we're just observers. What does that mean? We get to sit there. Is there any value to that?
I think there is. We hear all the conversations. We know what's going on with the management company, the portfolios. There was discussion about us taking a full LPAC seat, but I think us wanting to be a good partner, they were reserving it for much larger investors than us, and they didn't want to say Montana was the one exception. I have a fairly strong relationship with the founder. I think we met with them 8 times in 2019. We really wanted to be sure that this is a group we wanted to partner with, and so we have a very good relationship. And so I think their feeling was, even though we don't have a formal vote, we'll have quite a loud voice at the table.
Okay, thank you.
So Michael, how does this work with, what is the general partners tell me how it works with China and all the uncertainty around tariffs and viruses and stuff?
Yeah, timing is not great for this investment with the headline news. With the tariffs, less impactful for this specific strategy. They're really more focused around consumption within China, and so less impact of the trade war. Coronavirus, that will be interesting. I think it's unclear. Right now, I think the greatest impact is to retail, travel, and more consumption. Senate is a little bit more focused on healthcare, manufacturing, education. I think that's more in the medium and long term how those businesses will be impacted. So it's unclear. On the flip side, if things get worse, hopefully not, but it could be a good buy opportunity for Senate as a value-driven investor. But we'll see. It's really too early to tell with coronavirus and where things are headed. I think we're seeing different projections of how that'll affect GDP. Some say it'll be fairly minimal. Others I've seen a 3% forecast over a previous 5% for China. I would say it's probably too early to tell.
And so how does this work? Are they telling you that, or is that your assessment? Does the GP say, you make the investment and say, well, okay, just so you know, we're going to give it 6 months before we start doing anything, or do they not? Is that the level of communication that you have now?
It is. I think the majority of our direct relationships have written us emails giving us status updates on the portfolio companies and their investments. The Senate hasn't made any investments yet. I think they're probably waiting to see how things play out. But we're getting direct correspondence from our GPs, and then we're also seeing forecasts from economists and other news resources that we get directly. So it's a mixture of that and my own personal opinion.
Anything else? Anything else, Michael? All right. Moving right along. Tab 8, natural resources.
morning, everyone.
Sorry about that.
What are you doing?
Sorry, I just didn't feel the need to have 3 chairs up here. I wanted to sit closer to my colleague.
Well, you don't have to break stuff.
It's the extra bowl of Wheaties I had. Good morning, members of the board.
Come along,
about
did
his
you want,
anger issues
did
later.
you want to sit closer to me?
We are like this. We're a good team, if I can direct you to tab 8, we'll start by talking about Walton Street Real Estate Debt Fund 2. Want to give you a bit of background. Montana's been actively considering private real estate debt for over a year. During that time, we've looked at nearly 60 funds and reviewed them. As we were looking for the right manager to enter into this part of our investing strategy in the real estate asset portfolio, the key attributes we sought in a firm were a tenured team that had invested over 10 years together, and a firm that had a real estate equity platform that would provide deal flow access to the debt team, assist in knowledge of the real estate markets and borrowers, and allow for the firm to have the ability to take back an asset and operate it if necessary, if the loan were to default. And what we were successful in doing is finding all of those qualities in Walton Street. And we did make a commitment of $100 million on December 20th. This commitment establishes our private real estate debt exposure to a manager with a proven track record in real estate debt on core plus and value-added real estate. They have a vertically integrated debt platform that originates, underwrites, closes, manages, and reports on its commercial real estate lending opportunities. The firm is an experienced debt investor. They've closed on $2.8 billion in loans over the past 4 years and $7.4 billion since inception in 2004. They focus on performing loans secured by income-producing assets. The fund will lend on office, multifamily, and industrial properties primarily, and they only lend in U.S. markets where they invest equity. Important to our decision is the fact that Walton Street has an experienced real estate equity platform, and with this, Walton Street can supplement its sourcing, glean more market and debtor information, and take back and operate a property if necessary. And we believe the firm is collegial, hardworking, and has a great culture and a very positive reputation in the real estate space. Are there any questions?
So the type of properties, are they primarily in big cities, or I need a little better feel of the properties they might invest in or have a debt loan on?
Sure. They do focus on major metropolitan areas where they currently invest the equity. So we're talking Chicago, LA, back on the East Coast, New York. Just depends on where the opportunity is, and it's all about whether that is a good asset that's income producing. And they'll focus mostly on multifamily and industrial with some office, and there could be a bit of mix of retail in there, but
Do they originate the loans or just buy the loans from somebody else?
there are times where they will originate the loans, but then they sell off the senior portion. But typically they're coming in as that mezz lender, the mezzanine lender.
100% origination. They're not buying anything in the secondary market.
Yeah.
Repeat that again, they originate the loan, and then you said they sell off the what?
They'll sell off the senior piece of the loan to, for example, to a large bank, and then they're keeping the mezzanine portion of the loan where they can earn a higher interest rate to return to the fund investors.
Talk more about that, okay, what you're talking about, the mezzanine portion of the loan. Just kind of remind me, what is that?
We're all, I'm going.
Says the guy with the pink.
I asked for a different color, but they didn't have one.
The Rainbow Coalition.
Right, the rainbow.
Sure, so they'll typically partner with a bank, and they'll originate a whole loan. Part of that loan has what they call an A piece and a B piece, or think senior or junior. They'll sell that senior piece call it loan to value of 0 to 50% to the bank, and the bank will take that and hold it on their balance sheet. And then that 50 to call it 72, 75% loan to value, deeper into the capital stack, less equity subordination, higher yield. The fund will keep on its books, and because it's lower in the capital stack, less equity subordination, for example, it will earn a higher yield.
And so does the loan have two different
Yes,
rates on it? Yeah,
absolutely.
okay. All right.
Yeah.
Okay, thank you.
Sure.
What's in it for the borrower on that? I'm trying to understand why the borrower would borrow.
For example, they may not have 35 to 40% of the equity to put up, which would be attractive to a bank. The bank would say, hey, we need more equity to originate this whole loan for this entire loan for you. We can't do that. And so the equity sponsor says, oh, well, I've got alternative sources of capital I can go to. I've got a deal that can pay, has cash flow, can pay certain interest rates. I'll go to a debt fund to originate this piece of the capital stack that the bank is unwilling to loan to me. The banks have been retrenching and pulling back from the commercial real estate loan market since the GFC, and there are certain levels. It's really a structural issue that persists since the GFC and since the banks got really burned and made a lot of bad loans.
Anything else? All right, moving right along.
All right. With that, the next commitment we'd like to talk to you about is Oak Street Real Estate Capital Fund 5. This commitment of $30 million to Oak Street Real Estate is a re-up with an existing manager for us. The commitment continues our exposure to a manager with a proven track record in net lease real estate. Important to our decision is the fact that Oak Street's an institutional manager registered with the SEC. They have an experienced investment team and a solid experienced back office. Their strategies remain consistent from funds 1 through 5 with strong returns. Oak Street is differentiated in how they source and identify potential opportunities through their proprietary analytics. The focus of their strategy on high credit quality tenants and critical infrastructure company assets differentiates them from other net lease real estate managers in the market. This firm is highly driven and focused on its investors in achieving the best possible return. It's a collegial and entrepreneurially minded culture. Montana was able to participate in the first close of Fund 5 and in doing so received a preferred management fee rate of 1.5% on invested capital over the life of the fund. Are there any questions?
I have one that's always on these, it's like the preferred rate is 8%. What did they do on the first one of the return not yet?
For Fund 4, we're still a bit early into that. They're just finishing the investment period. We're currently at 8% net IRR. But Fund 3 prior to that was a 27% net IRR, and Fund 2 had a 20% net IRR. So we're anticipating strong returns from Fund 4 that we're a part of, and as well as for Fund 5.
It's one of the best series of fund returns I've seen out of any real estate manager ever, to be totally upfront.
Nice.
Question, so up in the strategy description portion, fund will, it's the last sentence there, fund will invest exclusively in investment grade, single tenant, freestanding, and then it has NNN, or double net lease assets. It's, just explain that acronym
Sure.
and then the double net.
The triple net lease means that
The 3 ends is triple net.
yes,
I got
three ends is triple net, where
I got
they
there.
they will
I
pay
knew
their
that.
own maintenance, their
I
own
knew
property
that.
taxes.
Did you want something for that?
Get them another pink cup.
Get him another.
Go ahead.
So there, it's a situation where, the manager, Oak Street goes in, they buy the asset and then they lease it back to that tenant. And the tenant is responsible for the property taxes, the maintenance, and any capital improvements to the asset. And the way that Oak Street helps to protect that investment is they monitor and track all of that work. They've completely underwritten the asset. They know exactly where it stands on maintenance needs and capital improvement needs. They also know who they need to pay taxes to, who the tenant needs to pay taxes to and when they're due. And Oak Street makes sure that they're tracking and monitoring all of that throughout the life of the lease to ensure that those assets are well cared for on our behalf.
Just a quick question. Number of staff, number of total staff, investment staff, team. What's the team?
Some firms are large enough that they'll have, their total staff, they'll have an investment staff and then just,
A management team? Is that what that means? Who's on the team?
it's oftentimes the same people. But sometimes there can be a broader investment staff that, and maybe we're only working with a segment of that.
Oh, okay.
It'd be like a large group, like a KKR, they would have thousands of people, investment staff would be probably still 1,000, and then the specific fund that we're investing in
Oh,
has a team of 20 people.
I get it.
Yeah.
We haven't done a lot of that, so that's why it's usually the same number.
Okay.
It's for instance, like that.
I get it.
Like we're a team.
I understand. Just want to know. All right. Any more questions? All right, moving along to DRA growth.
Yes. All right, DRA advisors. This is a re-up with an existing manager for us. Our commitment continues our exposure to them and they've had a very proven track record in value-added non-core real estate. Their strategy and investment process has remained consistent throughout the history of their funds. We've invested in funds 6, 7, 8, and 9 since starting in 2007. And our pension plan has benefited from accretive steady returns with an average of 14.5% net IRR and a 1.6 MOIC across the funds. Important to our decision is the fact that DRA is a highly institutional manager, also registered with the SEC, and that the real estate team is invested through real estate cycles and has depth of experience in navigating these cycles. DRA is differentiated in how they embrace deal complexity that will often deter other buyers in how they invest through joint ventures. They are also differentiated in how they can do both large and small deals with solid returns through cycles. The firm is focused on limiting downside risk, and they acquire assets where 2/3 of the return is cash flow based on in-place rents. We believe the firm has a strong culture and a great reputation in the real estate space.
Emily, did you mean in the comment, the commitment section to put 10, or did you mean to put 9 for the rehab?
Oh, I
Just
meant to
wanna make
put
sure.
10 as a typo. My bad. Thank you.
Mr. Chair?
Yeah.
So just so I understand the layout here, we've invested up to the 35 million, plus another 30, plus another 25, et cetera. And unless there were sell-offs, that is our investment accumulating in this, with this fund.
Not with this fund. Those are commitments that we made to previous funds, and so at this time, most of those dollars have already been drawn and invested.
Quite a bit of it's come back to
Yeah.
us.
Okay, so it has been come back to us in which format?
Income, appreciation, gain on sales. Absolutely, yes.
So those are the amount invested with this general.
At those times, it's not accumulative now to where we have, 150 million.
No.
Okay, and then, where does it stand here? What, I know we have preferred return. Does it say what has been our return on here?
It does not, but I mentioned it in my comments here that our average return from DRA over the funds that we've had is a 14.5% net IRR and 1.6 MOIC.
Okay, that's not on the back page, but you said that is what you.
Yes.
We haven't historically put returns on here. We certainly could. We can take feedback accordingly, however, however you'd like to proceed.
Useful if it's not, is it add to the complexity, meaning that would raise lots of questions because it's difficult to do, or is it?
No, it's easy to do. In fact, I think particularly in a case like DRA where we've serially re-upped, it would be good, I think it would be good information for you all to see, why we're re-upping. These folks, as Emily mentioned, have been very consistent in top quartile returns through the GFC, double-digit returns through the worst real estate cycle, certainly in my lifetime. That's one of the draws here. So I think, yeah, we can.
Would it be perhaps appropriate if in the commitment section that we would list what the historical returns have been? Okay, we'll do that. Thank you.
Any other questions?
Just a comment.
Yeah.
From my own perspective, surely it would be nice to know, but knowing you guys, you aren't going to do it time after time if we aren't making good returns. So I kind of assumed that was the case. It's good to see what
Yeah, absolutely. I mean, part of our job is just ongoing monitoring and making sure the organization continues and performance continues to deliver. And certainly, if any one of those or all of them fall off, that's a red flag and a reason to think really hard about a re-up decision.
The management fee is less than others. Is that because of the long-term
Well, it's,
relationship?
no, not necessarily. They actually approach how they assess management fees a little differently than other managers, and we reviewed that quite closely. They base their management fee on gross asset cost, which is not the same as basing it on committed capital during the commitment period or invested capital afterwards. We closely analyzed that to make sure that it was comparable, and it actually equates out, gross asset cost includes leverage, and when we analyzed it, it actually equates out to a 1.5% on average fee, which is right down the runway, right down the middle.
Right.
So that's very market comparable.
Other questions? All right. It's nice to see somebody from here.
Very busy. Very busy.
As opposed to Michael, just trying to buy coffee.
Okay, next up is Ecosystem Investment Partners. We have actually spent quite a bit of time talking about this manager and strategy over the last couple of board meetings, but nevertheless, we finally committed $45 million. Really like the firm, really like the strategy of mitigation banking. It's a great portfolio fit. The people are all rowing in the same direction, very passionate about the investment business, but also making an impact in the world around us. Performance has been solid, steady. It's accretive to our actuarial rate of return. It's 100% founder, employee owned. Really like that alignment and that involvement. Everybody in the firm invests in the fund, so they've got a real investor mentality. Great approach to partnership, open communication, accountability, and a very well-defined, repeatable, thorough, disciplined process. And I'm just really excited about this fund itself. I've actually been following this firm since Fund 2, but didn't have quite the flexibility to pursue something like this until a few years ago. And so I've been talking to them off and on. Anyhow, we consummated a deal and really looking forward to how it performs within the portfolio. Hopefully this will be one of our sort of long-term core positions within the natural resources asset class.
Is it a problem how do you monitor in case they are trying to grow too fast? They've got a history, I understand, but.
To grow as a firm too fast?
Yeah, they can't manage all the money they have.
Yeah, I guess that is one of those amorphous dynamics that are hard to pin down until you see something materially manifest in a shift in their process, a strategic shift in their investment philosophy, performance drops off. And if you see those, you know, it's incumbent upon us as the investment staff to ask the questions and really probe to get after what's driving that. And so it just comes through paying attention and asking questions when you see things that don't seem or feel right. I often refer to my spidey sense. You know, I really listen to my gut a lot of times. You know, you have to do all the blocking and tackling and the fundamental work around the people, around the process, documentation, et cetera. But you know, the human condition is really hard to quantify and benchmark, and so you got to pay attention. And hopefully, I've got enough life experience at 44, and I need more, but I pay a lot of attention, and I'm really a firm believer in partnership and getting to know these people, both professionally and personally, so I can continue to feed that spidey sense and give myself the most well-equipped barometer that I can possibly have to sense if things are going awry.
So I shouldn't take anything that you threw a chair over against a tree there.
You know, I stubbed my toe on the way out the door this morning, and maybe that's an after effect. But honestly, it was that extra bowl of Wheaties. That's all it was.
So, Emily, or even the one coming back to the sort of management fee questions, on any of these, the preferred return is a gross, or is that net of our fee?
That's a net. It's a net number. It's a net number they have to achieve before they can participate in the profit.
Thank you.
Sure.
Okay, and I know you've done this before, and I apologize, but one more time. What's the sale of land-based environmental offsets?
So,
Just give me a real.
okay, all right, sounds good. I'll give you a close to home example. So, outside of Helmville is the Nevada Creek Mitigation Bank. This was actually their sort of beta test for this strategy. The founder, Fred Danforth, owns this land. He has since passed away. But they went out and they remediated the land. All the stream banks had been beaten down by years of cattle grazing. The flows had decreased. The temperature of the water had increased. The fish population and the invertebrate populations had died off. And so they went in and they restored this 900-acre piece of property that Emily and I toured back to its sort of native state. And they did that under the auspices and the framework that is defined by the Clean Water Act, established in 1972, as administered by the Environmental Protection Agency. And they have a defined formula that, based on the level of remediation, they will award you what we call credits. And they create a bank that holds these credits. The bank is the piece of property that has been improved. And downstream in Missoula, for example, there might be an industrial developer, a commercial developer, a residential home developer that has bought a piece of land, entitled it, and determined that they can't develop it without negatively impacting a wetland that's on the property. They need to basically put asphalt over it or put gutters and sidewalks in and streets and so forth. And the Clean Water Act mandates no net loss. So if you're going to impact the environment, you need to offset that, and they do that by buying credits from the developer of the bank. And therein lies the whole scenario of their process. Gosh, we need to develop a bank that we know is in a watershed or a district that has significant development activity so that we can sell into that demand. And so they do a lot of analysis around commercial and residential and industrial development demand, oil and gas, power, utilities, et cetera, to make sure that they've identified the right deal going in that they're going to spend money on to improve, and then sell those credits into that demand.
Is it only Clean Water Act? Or is it-
No, the Environmental, or the Endangered Species Act, which is
Oh, you
also
do.
part of
Oh,
their
okay.
deal, which is administered by the
Mitigation.
US
Right.
Fish and Wildlife.
So Ethan, for the water, does it have to be the development in the same watershed as where the credits come from?
Yes, that's right. Yep. Good question. That was one of mine.
I read an article in the Wall Street Journal recently saying that, I think it was EPA, has been very slow in doing rules on carbon offsets so that the tax credits aren't working on that. I may not have that correct. Is that an issue here, or is this pretty well established and they don't need any rules and it's flowing smoothly?
So this is, so I'm unfamiliar with the EPA and the carbon work that they're doing. However, I can tell you with certainty that this is separate and distinct from carbon offsets.
And it is, I mean, it's functioning all over the place. It's
It
not
is,
just-
absolutely, nationwide, for sure. They have deals all over the nation. It is a national strategy, for sure. Yes?
Oh, just one more question. So, so Nevada Creek was one thing, right? So, but in terms of new deals, do they partner with a developer and?
So yes, great question. So on the ground, they will go into the local market, and do their own due diligence, finding appropriate operators with the right track record, in stream bank restoration or wetland restoration or
Right.
nutrient mitigation. So another benefit is they will go create a lot of local jobs in the area where
Okay.
they've identified projects to do development work.
Well, it was a great question, so I hate to say this, but that really wasn't what I was asking.
Well,
What I was asking is do they, so you're in Nevada, take your
Yes.
situation in Missoula, do they wait for the person in Missoula that's developing wherever and say, look, you're not gonna be able to do this unless, you get some offsets, so we're gonna, so they're banking these,
So they will identify the project on their own.
the cleanup project?
I'm sorry, maybe I apologize, I interrupted, maybe the question one more time. So
Are they partnering with the person who needs the offsets and then doing
No.
the work?
They are not
In order to
partnering.
get them the offsets, or they're banking the
No,
offsets?
no, they are not partnering with the local developer who needs the offsets.
Okay.
They partner with local developers who will move dirt
Right.
and create stream banks and so forth, but the industrial developer, the residential home builder, they are not partnering with those folks.
So they're doing the cleanup work and banking the,
Correct,
and
creating the
banking.
bank in anticipation of the forward demand. And a lot of times they'll actually sell their credits forward to lock in revenue up front.
Yeah, just follow up on that. How do they get linked up? How does the developer in Missoula know that these,
There's a couple of national databases
There's
maintained by
okay.
the U.S. Fish and Wildlife and the endangered, and the EPA,
EPA?
because they are, of course, the agencies that need to be, need to sign off on the impact and mandate
So the Missoula
to
developer goes, okay, is there anything in the Blackfoot or Clark Fork drainage? Are there any credits out there?
That's
I
right.
can
That's right, and then the mitigation banks actually have to register, and then you can see how many credits are available, how many have been sold, et cetera.
Curiosity question, are there a lot in Montana?
To my knowledge, no.
Okay.
This is in fact the only one that I know of.
So where does the profit come from? Where does that?
It's largely income driven. And so the margin is derived from, so they'll go in and develop a project, your cost, and then they will build in a profit margin for the individual pricing of the mitigation banking units. And they typically target a 2x return on invested capital. It's all privately negotiated. Depending on the market, you can see credits that sell for $2,500 to $150,000 to $250,000 per credit.
So how do we derive it? We have a $10 million investment, and then we'll sell for $20 million, and we get a margin in that, or does that?
So
how does it work?
I think you just answered your own question. I mean, we've committed $45 million. They will draw down that capital through time and invest it in projects. And as the projects come online, they will sell credits into the market and return capital to us as those credits are sold. And so that's how we realize our return. And if for whatever reason they don't sell those credits, or they happen to sell those credits at a price that is below their cost, we will lose money. If they sell all their credits and they sell them at prices at which they underwrote, we will get a rate of return that is 2 times our invested capital. If they sell them higher, we'll exceed that return. Did I answer your question? I just want to, okay, good. I just want to be thorough and clear.
It's a neat thing.
It's super interesting. I mean, it's fascinating stuff, and I'm glad you guys asked a bunch of questions because I'm really excited about this. And I mean, nothing's completely uncorrelated, but there's a nice diversification element here.
And last but not least?
Last but not least is Mountain Capital. This is a re-up with E&P focused manager. We committed capital to them back in May of 2017. These folks have a leveraged buyout approach. They buy E&P companies that are experiencing some level of distress. They are not loan to own. They don't go out and buy the debt of these shops and then convert it to equity and take control of the management company. They will source deals from hedge funds who have done that but are unnatural owners of an E&P company. They will source
And E&P is?
energy and production.
I knew what E was.
Exploration and production, pardon me. So think upstream drilling in the ground for oil and gas versus a midstream transmission storage company or someone who drives a rig out onto an oil pad and actually drills the well, so equipment and services. These are upstream exploration and production focused companies. So deep value approach, they like complexity. They will run a very concentrated portfolio. I think these folks are uniquely situated for this particular environment we're in. If we still believe that energy is cyclical versus experiencing some secular shift, bankruptcies have continued to accelerate and rise, and these guys have proven their ability to source distressed, deep value, complex deals. They've got a super solid team. Process is good. Their return has been accretive through what is arguably one of the worst downturns we've seen, certainly in my life, in interacting with some of the portfolio company CEOs that these guys have invested in who are 30, 40-year veterans. They're saying this is the worst downturn in oil and gas industry they've ever seen. And so the fact that they've continued to throw out positive returns, 10.7% net IRR since inception, is super encouraging. And the type of return I look for at a bare minimum when evaluating deals, making sure that they're going to be accretive to our overall target through time.
Ethan, could you talk about that, the issue of secular shift versus cyclical, what your views are on that?
My view personally is that oil and gas is never going away. And the shift towards alternatives and is real, it's happening. But I don't think it's at such a grand scale that oil demand is going to go away. I don't think it's ever going to go away. I certainly think that ESG is contributing to some of the apathy that's going on out there in the oil and gas sector. Up until a couple years ago, oil and gas was 16% of the S&P. It's south of 4% now, or right around that range. There's no doubt that sentiment is very low and has been for some time. But my personal bias is that this remains a cyclical industry, and as all cycles do, it'll cycle back. And now is a great time to be investing if you have that contrarian point of view, which I happen to. So think that's probably, if you need more detail or have more specific questions, I'm happy to
No, that
attempt to address
was where I wanted to go, but I guess I'd ask another follow-up question, which is sort of has the compression in the number of players in the game already occurred so much that we're sort of to a rational size to bounce back from, or do we still have to go through further compression before we start bouncing?
I don't think it's a market share issue, it's a supply issue. The market is oversupplied right now, plain and simple, and will likely be oversupplied for some time to come. I don't know what that time frame is, but certainly there's a lot of pundit and maven talk out there about the coronavirus and global oil demand falling off 2 to 3 million barrels per day from 101-ish million per day. And so in an oversupplied market, that's material. And I think that's why you've seen oil come off quite a bit recently, as of late. I feel like oil's probably found a bottom here, but you know, it's a very sentiment, geopolitically driven commodity, and we'll see where we go from here. But I don't think it's a market share driven issue.
Question.
Yeah.
So these folks, a lot of the companies that we've gone over the years that we're in, these guys are thin as far as
They
their
are.
staffing.
Very
So
thin.
that would seem like that would be one of the exposures. One of these guys, ladies gets taken out, bad things.
So an astute observation, no doubt. My response to that is they are an all hands on deck crew, and they run a very concentrated portfolio. They've got Bedrock, Revolution, Common, Escondido. They've got 4 portfolio companies right now that they're managing, so plenty. They are adding a new fund, targeting $650 million, which will translate into another 4 or 5 deals. You know, the heavy lift is really in the beginning stages of onboarding these deals and restructuring them, and, you know, perhaps changing out management and just really monitoring them hands-on, day-to-day, week-to-week, which they do. If some member of the team were to go away, yes, that would be a grave concern. Certainly, my impression and firm belief is that if that were to happen and it wasn't a key man governed by the documents, thus necessitating and mandating per those legalese that they needed to suspend the investment period, they would nevertheless pause and circle the wagons with their LPs and have a very robust, fulsome discussion around that. These guys are very hands-on with their companies, with their LPs, very transparent, very communicative. Sam O is very risk-averse, very conservative in his underwriting, do a lot of work on the reservoirs to make sure, you know, drilling completion techniques that are currently being applied are as good or can get better through their hands-on approach with management teams. There's plenty of in-place cash flow to service debt. One of their risk management approaches is to not buy a company with more than 4 times debt to EBITDA, which is arguably conservatively leveraged if you look at a lot of the E&Ps out there today that are 6 to 8 to 9.
Let me ask you one more follow-up
Sure.
on that. So when you would go and visit, this would be one where you'd make a visit, and visit them in Houston?
Yeah, we've done an on-site with them,
And would you meet, would you have made it a point to meet all the people and kind of just kick the tires and, hey, do you like working here?
Yep, that is precisely correct. In fact, another great question, and the answer will provide everyone further insight into our process. So, you know, hearkening back to some of my comments around partnership and relationships and so forth, yes, we, especially with a firm this size, we will meet every single person. We will interview them separately, behind closed doors, and very much ask them those questions. Hey, what do you think about Sam? What do you think about your carry allocation? How do you think about your base pay? What do you think about the culture around here, the decision-making process, et cetera? Are you included? Are you excluded? To assess the culture and just the general health and feel. And that's a big spidey sense deal. So very much part of our process and how we assess teams. Because, frankly, you can get every other aspect of the mosaic correct, but if you miss the human element, everything goes away and crumbles in a heartbeat. You need to get the people right.
Anything else? Before we move on? We need to move on, so next time you can explain to me what viscous versus the oil business means.
Nice cash flow. Ours been developed to produce.
Jim, you're up.
Anybody?
Good morning.
Good morning. I think we're talking about a summary of the quarterly performance in the fourth quarter. And as always, I try to look for somewhere in the 10,000 statistics that we throw at you, a few that may carry some messages that are worth lodging in the back of your mind about the performance of the fund and issues that might come up over the next year, and also provide some context to understand how well or how poorly the fund is doing. And the fact is the fund is doing well. Not quite hitting on all cylinders as it has for the last 4, 5, 6 years, but still pretty well. Maybe we can start with the executive summary and a few comments there, and then we'll move to the performance report itself. I'm on page 4. And just to give some context for the numbers that you're going to see on the table above, look at the full year of it's calendar year to date 1 year, so that would be the year 2019. Truly an astounding year in terms of capital market performance. A bit of a surprise given how high the market had already been in terms of value. And moving for different reasons. If you look down that line, that column, I should say, what you'll see is just tremendous performance by the U.S. equity large cap market, over 31%. We haven't seen a number like that, I think, since 2013. Small caps, a little bit less, but still an enormous absolute performance. International stocks, the next one, MSCI EAFE, and emerging markets, also, while they did not perform as well as the U.S. market, as I think you all know, the absolute returns were still very substantial. One thing stands out, though, if you look at the bond market and you look at the row, Bloomberg US Ag, you'll see that in 2019, an exceptional return that stands out vis-a-vis the 5-year and the 10-year number. That was the sharp decline that we experienced in interest rates, and it produced probably a one-time, or at least for the moment, one-time boom in fixed income capital appreciation. You can get a sense of what that means by simply going left and look at the fiscal year to date and the most recent quarter, and you can see that after a big interest rate decline, when you capture that capital gain in the bond market, then you have to then rely on the yield, and yields are very low right now. We'll spend a little more time on that. This issue of the U.S. market outperforming the foreign markets, you can look at the far right-hand column. This is a 10-year phenomenon now. So if you look at the top two cells, which are the S&P 500 and the far column to the right, you can see that those are double-digit returns annually for 10 years in a row. That doesn't mean every year the U.S. market went up. In fact, it didn't in 2018 because of the fourth quarter meltdown. But nonetheless, when you on an annualized basis, that is what has produced these historically high valuations for the U.S. equity market. And you can see how big the gap has been over a 10-year period between the annualized returns of the U.S. markets, the first two cells, versus the next two cells. One other thing I would point out, and that is, and it relates a little bit to the conversation you had yesterday about the trust funds and real estate. The real estate market is behaving quite normally, but returns are going down in absolute returns. If you look at the row that says NCREIF ODCE, you can see that the 10-year number is truly astounding, and you have benefited very, very much by being in that market over this period of time. But as you can see, as we move to more recent periods, the annualized rate of return has gone down. So that's normal. There's nothing unusual about that. So with that as context, maybe we can turn to page 9 and just look again at the absolute returns that you see in the far left-hand table. If you look at the 1 year, and I like to focus on at least the 1, 3, and 5 years, not the most recent quarter, because those bounce around. As I think I've demonstrated in the past, they have they can bounce around crazily and not tell you much about the trend line in returns. But you can see how many of them actually exceed your actuarial rate of return, which is good news for the valuation and funding ratios of the plans, all else being equal. And of course,
I'm lost on the page. Where are you at?
page 9 still of the executive summary.
But then on that page,
Oh,
where you're at,
I'm on the left-hand table at the lower left-hand corner. The one thing I did want to point out that John and staff will probably talk about when they review fixed income is how deadly flat the yield curve is. We've talked about it before, that for periods of time it actually inverted. So look, for example, we're looking at the right-hand side, that bar or that line chart. Take a look at the blue line, which is where the yield curve was in September of last year. You can see that there was a slight yield curve inversion going on, which means that you are penalized for actually putting your money up for a longer period of time, loaning it out for a longer period of time. If we look at where we are today, or at least where we were at the end of the year in December, when the year closed out, 2019, that's the green line. You weren't being paid much at all to take duration risk, to loan your money out for longer periods of time and have it exposed to the borrower. We'll talk about this a little bit more when we talk about risk premia in the second presentation that we'll give. So let's get to the details of the fund, and that means turning to the actual quarterly investment performance analysis, and not the executive summary, it's the larger report. And perhaps we can go to page 6. I said that the fund was doing well, but not quite as well as it has in many recent years. And there are 3 ways that I like to look at the performance of the fund. I think I've said before that I used to live in New York City, where there was a mayor who walked around and said, "How am I doing?" And so when you ask the question, how are we doing with respect to the investment performance for the fund and its bearing on the pension plan, one way to ask the question is, how are we doing versus the expectations that were set by the actuary in setting contributions? We talked about that yesterday, the assumed rate of return. So the way to look at that is to look at the very top row. And what you can see is that over 3 and 7 and 10 years, the fund's investment performance has exceeded the assumed rate of return that, again, as we talked about yesterday, the actuary has decided to use to set contributions. Now, we know by looking at the numbers that we just looked at in terms of context that this has been a very good 10-year period. So if we ask the question, how are we doing versus what the actuary's expectations are when he recommends a particular contribution rate, the answer is, over the last 10-year period, quite well.
Mr. Chairman? I want to make sure I understand it, because I'm looking at it wrong by what you're describing here. Like in year 3, you got 9.28,
Yes.
27, and there's a negative 4.43.
Well, I'll get to that in a moment. In fact, I think I can answer your question right now. Is it,
would be the way to do it.
maybe I should wait until I get the question.
I like the suspense.
So these are the absolute returns. This is how much the fund gained in terms of actual dollars returned into the fund from its investments. Then the question, the second way to ask the question, how are we doing, is how are we doing versus our execution benchmarks? That is, even if the returns were huge, that means that the capital markets went up, and you have a set of expectations that you yourself have put in place. It's called your benchmarks for your each asset classes, which roll up to a benchmark for the fund as a whole. And the question is, did you execute versus your expectations as well as you might have liked? That's the negative number that you see in the third row, and in the third row at the top. And what it says is that you have fallen a little bit short of that. And in particular, in the last year, you have fallen very short. Now, we've had this conversation before. A lot of that is associated with your illiquid private investments, because your private investments are benchmarked against the public market. And so when the public market takes off, your private investments lag in terms of how fast the accounting for their performance is recorded and takes and then eventually matches the public markets. And we know the public market in 2019 went up 31%. We know that that is a very difficult rabbit to catch if you're only getting your real estate appraised, quarterly or even less frequently. If your private equity lags in terms of the values of companies that are private that have to be assessed. And so I would not be terribly concerned about that, so long as it takes place in a market where the public market, where you're benchmarked against, is skyrocketing. If these numbers were in place during a market decline in the public markets, they would be concerning.
Jim, the construction of the public employees benchmark is sort of an average of all of the public employees plans, or talk about that construction?
Well, it's a weighted average of the asset allocation.
But not of our plan, of all.
Well, of the cap, and because you have the same asset allocation for all of these plans. So the pension plans, if you look down these numbers, they're almost all identical. And that's because they're all feeding off the same portfolio. So the benchmark is really driven by the portfolio, not by the plans themselves. Now, should you ever find reason to have a different asset allocation for some of these plans versus others, then you'd see different pages for different plans and potentially different benchmarks. In fact, almost surely different benchmarks. And there are funds that do that have different asset allocations for different plans because they're in dramatically different circumstances.
So what you're calling the public employee benchmark is a roll-up of all of the benchmarks for the component parts of the
fund.
Of our fund.
Right, and we
That makes
could
sense,
pick the teachers and have the same discussion.
So for our large cap, we have a benchmark. For small cap, we have a benchmark. For private equity, we have a benchmark. For real estate, we have a benchmark. For each one of those types of investments. And so the public employee benchmark is a roll-up of those for the whole fund. Does that make sense?
It's not like.
I think what they're doing, so the benchmark is basically allocation in our fund, not the average benchmark or average allocation in other public funds.
No, but
It's our benchmark.
Got it.
yeah, just in your asset allocation. And that happens to be the asset allocation that's applied to all of these plans, which is why the numbers are identical virtually. Now,
Another little question, if you might, mind. So, in saying that there be gains recognized in the private capital side, well, will these more current numbers, the quarterly, this fiscal year, will they, as they move forward or move backwards, will those gains be increased
yes,
or recognized?
the answer is, over a much longer period of time, the effect of that lag starts to wash out. And so these are called time-weighted rate of returns, that the effect of that 1 quarter or appraisal lag washes out and becomes much, much smaller over 10 years. And so, but, you know, over the last couple of years, you've changed your benchmark for private equity for several reasons. One is that your previous CIO wanted an investable benchmark. So that solved one of the problems of the previous benchmark, which was not investable. But it did not change the fact that your benchmark is driven by what happens in the public equity markets, the stock market itself. So, you know, you kind of had one benefit, but you weren't able to address the other side. And one of the challenges that I think our team needs to do, working with your staff, is to because there's new history, because there's a new benchmark. I think we need to, in order to help inform you about how your private real estate and private equity are doing, we probably need to go back and sort of do some historical analysis on the old benchmark, the new benchmark, so that you're not left in the dark as to the most important comparison when we look at it like this, which is the long-term performance of private equity, where the lags wash out, versus the long-term performance of a public market benchmark. I think I've confused everybody.
But don't worry about it, because if you don't understand, you can rest assured we will be visiting this. Every meeting we talk about.
At least 15 minutes.
What?
At least 15 minutes. That was
But I was worried we weren't going to get there this time.
Yeah.
I'm glad to see we did.
So, so the third way to ask, how are we doing, is to ask the question, how are we doing versus what other plans are doing? And this is, we've said this often before, this is the shakiest of the comparisons, because other plans are doing what other plans are doing. They don't have your liabilities, they don't have your risk preferences, they use sometimes different asset classes and so on. But it's not a, it's the least useful, but still a useful and worth considering benchmark. Here you're doing quite well. So where you see that is in the 1, 2, 3, 4, 5, 6th row down on page 6. And you see something called a rank. This is your return versus the returns of a large group of other plans, all over $3 billion in, at least $3 billion in size. And as you can see, over 10 years, it's really astounding. I mean, you are doing terrific. Over 7 years, you're doing terrific. Over 5 years, you're just on the outside of the first quartile. Recently, you know, you have come down and been just above median. If you look at calendar year 2019 or the 3-year number, those are good numbers. And I will tell you that it is extraordinarily hard, and we said this at the time when this fund started turning in these kind of numbers in the top decile and the top quartile, it's very hard to stay there.
Well, you don't think that trend is a concern?
No, not necessarily. The fact of the matter is that we did an analysis some years back that asked the question, we call it the Zen analysis. How do you get into the top quartile or the top decile over a long period of time? And the answer is you don't ever have to actually be there for any given year. You just have to be above median, because other funds will be below median and above median, most other funds. And if you're consistently above median, over time you will gravitate for these longer period of times higher and higher and higher. in the long-term rank. So I think that it would have been a shock to us if you had stayed in the 2%, the second percentile of funds for forever. I mean, that would be astonishing.
That line number 6 there, I mean, that does relate to line number 3, and your observation about the lag with the illiquid private investments not showing up on line 3 is also means it's not going to show up in line 6 either, or am I reading this wrong?
If I could say you're partially right, it mostly relates to line number 1. It's total return. And we'll see a page later where you will see that you are not any more harmed by the lag in recognized returns on a timely basis than most other funds. So, yes, you could be, but I don't think you are. And we'll have a page where we can readdress that question.
Okay.
And I always have to remind myself this, but line 1, that's what we're calling it. So the 3, 5, 7, 10, 20, and since inception numbers are, we have gotten that return.
Yes.
Net of fees.
Yes.
Over that period of time.
Yes.
Per year, compounded.
Yes.
And then on the 2% on year 10, is that a percentile?
It's the second percentile.
Okay.
Yeah, so it means that
On the top,
there were
2%.
1 or 2 funds above you in this
About
composite.
2%, right.
Okay, thanks.
That's one of the few places where big numbers are bad.
Yeah.
People like big numbers.
Right, that makes sense.
There'll be a few others. So, a good address to your question is actually on page 9. So on page 9, what these numbers are, and I would point you to, these are your allocations versus the allocations in about 40, you can see the population universe that you're being compared to, between 34 and 47 different funds that reported allocations to these asset classes. So, and I think this may help answer your question about are you suffering more from the lag in terms of time-weighted returns than anybody else. So let's start left to right where it says about 2/3 of the way down below the floating bar charts, as we call them, it says total retirement plans with a green diamond there. On U.S. equity, you're in the 33rd percentile. What does that mean? That means you have a bit more, a good bit more, than of U.S. equity than the average or the median of these 46 funds. So if you take a look at the median, you see the median fund is holding a little under 27% in U.S. equity, 26.68. You're holding 30. That's a meaningful difference. Remember that we always say asset allocation drives performance more than any other decision you make. Whether you hire this manager, fire this manager, those are all helpful, but this makes the big difference. That is a big difference, and that is one of the main reasons why your fund has ranked above median for this long period of time. International equity, let's move just to the right. You're in the 65th percentile. That means that you have a little bit less exposure to international equities. You can see the median plan has 18.41 of the 45 plans that reported an allocation here. Now, that's been helpful to you because while international equity has had decent absolute returns, they haven't been as good as U.S. equity. So again, asset allocation has been a big driver of your success. Fixed income, you're in the 26th percentile. And you can see there that you hold, you're about at the first quartile in terms of your fixed income allocation. You don't have any international fixed income. And now here's the point where I get to your question about whether or not your time-weighted total fund returns suffer more recently from this lag. And you can see that in alternative investments, you're in the 77th percentile. So the median plan has alternative investments of 19.21%. You're at 14.56%. So it is unlikely that that exposure to this time lag is one of the things that is any way harming your peer ranking. Real estate, where you have your real non-equity, non-fixed income exposure, which has been a great decision by this board and your staff. You actually are just inside the top quartile in terms of exposure to real estate. Been very beneficial. You have 8.7%. The median plan is 5.23. And cash, you've been carrying a bit more cash. You are in the top quartile. You had a lot more cash, and Dan and the cabinet have been addressing the cash issue over time, and I suspect that that's an allocation that will right size over time. Am I correct about that? Okay.
Jim, quick question for you. The alternative investments category here, would that be things like hedge funds and such that we don't have as well in addition to private equity and other?
The answer is yes. It would be private equity, it would be hedge funds, it could be real assets, anything that wouldn't fit into the other buckets. So, but the majority of it is likely to be private equity because that's the largest, for public funds, that's the largest category of alternative investments.
Can I just quickly ask, has hedge fund ownership come down in public plans?
For some public plans, but it hasn't really, I haven't looked at the numbers very recently, but it has changed a lot less than the newspapers would lead you to believe. There have been, because there's been some very highly publicized exits from hedge funds like CalPERS, for example. On the other hand, CalSTRS decided to stay in hedge funds. And so what's interesting is that hedge funds as a category have actually grown. Now that's all client types, and there are still assets in them that are growing over time. Probably much of that is market appreciation, but their returns have been less than equity by a wide margin. Not that they should be able to keep up with that. But during the big interest rate decline, they were even less than fixed income, which doesn't speak well for hedge funds. That may change here with interest rates this low. In fact, I think last year hedge funds had their best year in probably 7 or 8 years. Let's see, what's next? One of my favorite charts is on page 11. And the reason it's on the upper left-hand side. One of the reasons that we like this chart and we encourage clients to include it is that returns are fine, but if you took an extraordinarily high amount of risk to get them, that's not necessarily such a great idea. And so one of the things that we track, and there's many ways to track risk, but one of them is how volatile is the performance of your fund. It's an indication, one indication of how much risk you have. So if you look at this upper left-hand chart, what it does is it says, okay, the y-axis is return, and the x-axis is risk. So if we were to take a look at your benchmark, which is the purple or the blue circle, it actually is riskier than in terms of volatility than the median plan because it lies to the right of that median bar vertical going for these comparable funds, peer funds. But your execution of your asset allocation has been far less risky. So I think that's a compliment to your staff. We're talking about over the last 5 years. You can see that the green diamond actually is very comparable. In fact, I think it's just slightly above your benchmark return for 5 years. But the actual recorded volatility of your real portfolio is less than the benchmark itself. That's a good sign. In fact, as a general rule in these charts, the best place to be is in the upper left-hand quadrant, because you have, if you're in the upper left-hand quadrant, you have returns that are above the horizontal median, and you have observed risk that's less than the vertical median. That's a great place to be. The worst place to be is just the opposite, the southwest quadrant, and you can see there are funds there that have below median returns over 5 years, and yet they've had observed volatility that's higher than the median plan. And fortunately, you're not there. In fact,
Does the trend, if you look at the 5-year versus the 10-year, does the trend towards more volatility and less return value?
not necessarily. You know, it bears watching. But keep in mind, if you look at the, I think the chairman is looking at the next page, page 12, and the upper left-hand chart again, which covers 10 years, which, as I mentioned before, the 10-year period is exceptional. The most recent few years are above median, but not shoot the lights out, which is hard. And you can see that when you look at, this bears out when you look at this chart, that you are deeply in that wonderful quadrant on the upper left-hand quadrant. We call it the northwest quadrant, that's a good thing to say, where you were achieving over this long period of time way above median returns, and yet still exhibiting less volatility risk. That's a good place to be. So, back to answer your question, if you were to, you know, drift down into the southwest, to the southeast quadrant, that wouldn't be necessarily a very good sign. Yes.
Well, we're headed in that direction.
Yeah,
We're
but you're
moving
still
to the
above median, and you're not taking more risk. This is a very slow-moving chart. You know, it's not.
Okay. I don't want to be moving to the south. No, Florida personally, or
Yeah.
you know.
Yeah.
Yes.
Alabama awaits you. Though.
Yeah, no.
Good question, but I never realized this before. If we go back to page 9 and we're looking at public employee benchmark, there that means our asset allocation.
Yes.
Okay. Now we switch to page 11. Now public employees benchmark means the average of the 49 plan sponsors.
No, it's still yours.
Oh, then I'm not understanding this.
It is your benchmark, your total fund benchmark rolled up. And it would lie, if you just met the benchmark characteristics, you would have had more volatility and roughly the same return, but you achieved it with less volatility.
Because of the execution.
Because of the execution.
Okay, that's what we're saying. Okay, got it.
Okay.
About 5 minutes left. Good. About 5 minutes.
Okay. Since there was a discussion yesterday on the trust fund, I wanted to look at page 14 and just point out something to keep in mind. I think John mentioned yesterday that the yield on the trust fund was something just over 2%, John. Yeah. And so if you look at the trust funds here, so I just wanted to call.
Sorry, Jim, which page?
I'm on page 14. 14. And it's the middle panel where it says trust fund investment pool. If you take a look at the investment returns for 10, 7, 5, 3, you can see that there's a gradual decline going on, with the exception of the capital gains that were achieved last year because of the interest rate decline. And then they've declined somewhat further. You can see that now that in the last quarter of the year, they were running at 0.45% for a quarter. So if you multiply that by 4, you don't get a lot of return. So this is, I'm sure, part of what prompted your staff to take a hard look at, is there anything that they could do to the investment exposure for the trust pool that could raise that number somewhat, because we all in the fixed income market are somewhat captive of what yields are, because there's no real alternative to them. other than to go outside the fixed income market to some extent, as you discussed yesterday.
Jim, do you account for inflation on those trust fund numbers?
The answer is no, these are nominal returns.
So with inflation in there, we're actually negative.
Hmm?
With inflation accounted for, we'd be negative in our returns?
The answer is yes, you very easily, if inflation was running at about 1.7, 1.8%, and your yields fell below that, yes, you'd be at negative real returns.
Jim?
So with change in policy yesterday had more real estate change, the high yield and so forth, we need to come up with a new index for this trust fund one, or how will we do
I
that?
think that's a very reasonable question. I pitch it to John, but if there's a change in the exposure to the plant for the fund, then the benchmark needs to reflect what the fund can and is expected to invest in.
The benchmark we already have core real estate in there, so it's the average weight of whatever real estate is versus the OBCE. I don't remember if we didn't talk about that too much yesterday, but we did move it from the REIT index back to the OBCE because it's a better match. As far as the benchmarking thing goes, we get a whole deep dive in April for benchmarks, so we can go there.
Good question. What's a private
It's counted for, so you're
We just lost our quorum, right?
One more question. So on page 16, since inception.
16?
Page 14. 14. Since inception, we've done pretty well on the trust fund.
Oh.
I see 6.10 since
You
inception.
stole my thunder. The last point I was going to make is that the execution of the trust fund pool has been excellent.
Yeah.
As you can see, it's an unbroken stream of beating a simple investment in the Bloomberg US Ag bond market.
But I would say to that point, Jim, we have both Jims. We have continually kind of reduced our risk, I would say, to some degree within trust fund, and it gets harder and harder to beat because returns have become so compressed, and we don't think we're getting paid for it. So, kind of that relative outperformance. I mean, another reason we're thinking about real estate, that relative outperformance is, I don't think, possible within the bond market currently.
Okay, I know that we're pressed for time, so I just wanted to spend a little bit of time on the main composites on page 16. If you look at domestic equity and international equity, the first two panels on this page, what you see, again, are good absolute returns, but a bit of a difference in terms of execution returns, execution capability. In the case of international equity, the sixth line down shows that for the 1 year, 3 year, 5 years, 7 years, 10 years, your portfolio, that is all of the mandates you have and the managers you've chosen to execute them, have actually done better than the international benchmark that you use. That's not true with respect to domestic equity. I will also say that, in the case of where some of the challenge lies, some of it lies in large cap active, but a good bit of it lies recently in mid cap active. So I think, I know I talked to John yesterday, this is an area for this year that we're going to look into and try to suss out what the drivers are.
Jim, I was reading the agenda wrong, so we do have a few more minutes.
Oh.
If you're...
Well, I always have
Another
more.
important point.
I have way more to talk about.
Oh, maybe I should.
I guess, we've talked about private investments and that issue. I don't want to go into that again. But I will turn to page 17. We saw just in the...
Before we do that,
Mhm.
I mean, the big red numbers are natural resources. On page 16, do you want to talk
Yeah.
about those for a minute? or-
Yeah, I am not sure about what the driver of that is, but commodities did do poorly. Look at the absolute return, and I think oil prices could be part of that. I don't know, I would ask if Ethan has something that he wanted to throw in on that. Real estate, similarly, we know that from areas where we are the real estate consultant to clients, that there have been write-downs in a number of funds of retail real estate, particularly malls and other retail-oriented bricks and mortar. So those could be the two drivers. Ethan, did you have something you wanted to throw in on that?
Well, real estate in particular, the REIT index was up almost 30% through calendar year
Good point.
12/31/19. As you know, most of our real estate exposure is private. Valuations are lagged. We'll be having a discussion with the board, just to preview April, about changing back to what we think is a more appropriate index. So that's real estate. Natural resources, I was poking around the other day. A lot of that's J-curve stuff with some new funds. It's also being driven by our Chickasaw exposure in the publicly traded MLP separate account that we have. They were down 8.6% inception to date through 12/31/19 from an overall total return perspective. So that's
So that, what is that, Chickasaw? Was that the buyer one?
No, sorry, Chickasaw is a publicly traded, long-only separate account that trades master limited partnerships and other C corps that have restructured out of the MLP sort of legal entity into a corporate structure, but nevertheless execute the same sort of business model as your classic master limited partnership that owns, operates, energy transmission, storage, et cetera.
I would say the commodity benchmark as well is quite a mismatch with what we have. So it's probably, it's like a third agricultural stuff, a third metals and mining, and a third kind of oil and energy type stuff. And so we probably don't really have much of the first two in there, to the extent that gold, as an example, went from, I don't know, 1,200 to 1,600 here recently, and you got a pretty good gain in some of that we just don't have exposure to. So it's not a real kind of good match with our assets and that side.
Not to beat benchmarks to death, but it sounds as though there's a philosophical question vis-a-vis where your previous CIO had his convictions about benchmarks. He was adamant that the primary, maybe exclusive rationale or principle for a benchmark is that it had to be public and investable. And whether or not that matched well to what you were actually invested in that was sort of casualty. Is that a fair assessment? And now that's an issue that your staff wants to re-examine. And it requires us to do a lot of changes too, but it's better to have a good benchmark that explains to the board as best as possible how well the asset class is being managed, as opposed to necessarily how it might be managed if it was invested in something else.
Yeah. Well, we'll get into this in April more.
If we have a quorum.
Right.
Now that we've previewed how challenging it would be. I did want to look at page 17 and just make one point there, and that is in the domestic equity. We saw on the previous page that from an execution point of view, the domestic equity portfolio is falling a bit short of its benchmark, which is not an unreasonable benchmark in that particular case. So that's not necessarily a good thing. But I would point to the third column down where it says rank. Now, you know, when we look at the total fund, you've heard me say, and you hear Becky say as well, don't lean too hard on peer rankings when you're talking about the total fund, because asset allocations differ, all kinds of things differ. Ranks become a little bit more reliable as a potential indicator of how well you're doing. The narrower you get and the more homogeneous what you're doing is to what everybody else is doing. And that's generally, that is the trend when you get down to something like domestic equity. What you're doing in domestic equity is a little bit different than what other folks are doing, your peers, but it's not different in the same way that your asset allocation might be. So the peer ranking becomes a bit more informative to you. And despite the fact that you are underperforming your benchmarks over these periods, you are actually outperforming your peers trying to do the same thing being investing in domestic equity. So for example, if you look at the ranks of yourself, your fund versus the peers that we use here, you can see that your ranks are all for 1 year, 3 year, 5 year, 7 year, 10 year, are all above median. And those are solid, which means that of all the folks that are investing in domestic equity among institutional investors that are generally your peers, you're doing better than the median manager out there. That doesn't mean that you're doing better than the benchmark. That clearly is not true. So, but I think it should ameliorate to some extent it informs the answer to the question, how well are you doing? So you're not doing particularly well versus the benchmark, but you're doing better in pursuing domestic equity investments than the median plan. If you look at page 18.
On that page before you change. So you talk about international equity the same way then?
The answer is yes, and what's interesting, and I think I pointed this out before, is that in the case of international equity, you're doing better than the benchmark, but your ranks are actually not quite as good as you are in domestic equity. That means that you're beating the benchmark, but some of your peers are even beating it by a little bit more. And this goes back to our active passive study, which for years, and we're going to redo it again now that we have the full 2019 analysis, shows that international equity emerging markets are places where active managers, by and large, the median manager does a little bit better than the benchmark. So there are a lot of funds that are actually beating the benchmark. So your ranks are not so high, but your execution versus your benchmark is better than it is in domestic.
Now we're done.
Okay, now we're done. So maybe I'll finish with a risk-oriented point that I wanted to get across, which is on page 18. We often talk about exposure to the U.S. equity market as a measure of risk. Why is that? Because if you look at downside risk in almost all categories, equity is the most volatile and has in 2000 to 2002, in the Great Financial Crisis, and in the 1987 crash. I mean, you can go even the fourth quarter of 2018. It can decline 20%, whereas it's really hard for the bond market to decline 20%, or the real estate market for that matter over a short period of time. The equity market can do it. So one of the risk measures we look at is how much your total fund, with its asset allocation and how you're executing it, how sensitive is it to the ups and downs of the equity market, the U.S. equity market, because that gives a clue as to how much the fund would be harmed by a big downturn in the U.S. equity market. So the answer to that question is in this green dotted line. All the other lines show various subcomponents, composites, asset classes, and their sensitivity to the U.S. equity market. So for example, domestic equity is almost exactly 1, right? It varies a little bit more or less depending on the mandates you have and what the managers own. But what you're most interested in is how would the fund fare. And the fund's sensitivity, observed sensitivity to changes in the equity market has actually been gradually declining since about 2014. And that's, if you are concerned about the high valuation in the U.S. equity market, that's a good sign. It doesn't mean that it would protect the fund's value if the U.S. equity market went down. It would certainly harm the fund. But what it means is that you're not positioned to be exceptionally harmed. Despite the fact that you have your largest allocation is to the U.S. equity market. It means that your other allocations are sufficiently diversifying that when you look at the total funds behavior, it's not as sensitive to the equity, US equity market as you might think. So that's my last point.
All right, any
Question,
last
yeah.
questions? Yes.
So on the measure on the left-hand side, what's that measure? There were 0.6 in that bar.
Yeah.
What is that?
Well, let's look at the blue one, because that's the simplest one. The blue one is the sensitivity of the US equity market, of your domestic equity composite, the way you've invested your asset classes, to the US equity market. Now, since all your domestic equity investments are in the US equity market, it should be 1. That means that if the US equity market falls 10%, it should fall 10%. Now the question, now translate that down to the green line. If the US equity market falls 10%, your total portfolio should fall a lot less than 10%, something more like 5.5% if you look at where the current end point of the green line is, which represents the sensitivity of the total fund to that 10% change in the equity market. Is that helpful?
So what does this tell us?
It tells you that despite that you've been able to invest heavily in the U.S. equity market and benefit from it, but you've surrounded that investment with diversifying investments so that the total fund is not as sensitive to a 10% or 20% or 30% decline to the equity market as it would be if you owned nothing but domestic equity, for example. Or even domestic equity and international equity, which international equity is fairly highly correlated with what happens in the U.S. market as well. And all of those diversifying exposures are that nest or that tangle of lines down below, the reds and the purples, and they show very little sensitivity. They're all clustered around 0. And that means that the equity market can go up, it can go down, but in most cases, observations so far show that these values don't change so much. So they are a good offset to the equity exposure that you have in the portfolio. This is essentially, your executive director gave you a presentation yesterday about the prudent investor rule. This is at the heart of the prudent investor rule. You can invest in something as risky as equity, particularly if you have uncorrelated exposures that soften the ups and downs that you would expect from a riskier investment.
Okay. Okay, Bart, we'll take a break at 10:30, please. Ready? Oh, okay. All right.
Oh, good Lord.
So let's see. We're back. We're back for capital portfolio liquidity analysis by Jim, and I think Dan, you wanted to start us off here.
Yeah, Mr. Chairman, this is in response to Mark's question from October when we first presented the 2020 asset allocation to you. And the question was, how illiquid can we go and still be able to make benefit payments? So, as we look at additional diversification, as we look at higher return opportunities, that necessarily brings with it some illiquidity concerns. We spent a good portion of October, November, December working with RBK, their team, our team, passing things back and forth. Our privates team, an alternative team, really spent a lot of time with risk. So this is the product of those conversations, and I think you'll be, as I was, a bit surprised, but pleasantly surprised by the outcome. So thank you for your team for all the work.
Well, thanks, and indeed, this was a classic example of good collaboration with your staff. We've said it many times, we work for you, but in order to do a good job for you, we have to have a great working relationship with your staff. It's that simple. So this is yet another example of that. And it's a question that is coming up with a lot of institutional investors because as a general rule, assets have been gradually moving into less liquid categories, more illiquidity. So from the point of view of pension plans but also for insurance companies or even endowments that have spending policies, whether they can continue to do their mission given their commitments to illiquid investments is important. Step back a little bit. Why invest in illiquids anyway? I think we all know that one of the principles of institutional investing is if you don't want to take any risk, you'll buy T-bills and you won't get much return. So then the question becomes, okay, that's unacceptable. So then the question is, where are risks out there where at least capital markets history shows that there is a return associated with taking the risk? So just to mention a couple of them. There's equity risk. These are called risk premium. You take equity risk, you're taking the risk that the economy and companies within the economy and earnings associated with it will produce higher equity values for economic entities we call companies. That's equity risk. And over a long period of time, it has produced a premium over risk-free investments. So that's one example. You take credit risk, which is kind of the fixed income version of exposure to the risk that that the entities that you've loaned money to will or won't be able to pay you back. And there's a payment for that. We call that the spread. There's duration risk. You know, the longer you're willing to give somebody, some other entity, your money and be at risk before it gets paid back, you should get something for that. In the current, we just looked at the yield curve, and there's not much of a premium associated with that these days. And then there's illiquidity. If you're willing to tie your money up for 10 years, as in the case of private equity, generally speaking, private real estate, and there are a number of other types of illiquid investments, you should get paid something for that. And over time, there's been a premium return associated with being willing to become illiquid for a while. So it's not crazy to put money into illiquid investments, but then the question is why? And on page 2, you can see that this board has gradually increased its allocation to illiquid, less liquid asset classes. Real estate is a good example, but private equity is an even better one. And as I just said, illiquid asset classes provide benefits, but they also create risk because it's very difficult if you need those investments to be returned to you in cash right now. There's a significant penalty for doing so, and sometimes it's not even possible. So one of the questions that we focused on in this, given Mark's question, was what are the various types of risks that are associated with pursuing the illiquidity premium to try to get additional returns so that you can pay benefits. If you look at page 3, we looked at 3 different ones. One of the ones that is important is if you have money tied up and you need to make payments. Say, for example, your contributions to the pension plan are lower than your benefit payments. That means you have to take some money that's in the portfolio and move it out. But if it's tied up in illiquids, all of that call for liquidity has to come from other parts of the portfolio. If other parts of the portfolio, given the cycle in the capital markets, happen to be at low valuations, you will be forced to sell at whatever those prices are, whether you like it or not. So, that's one risk. Another risk is portfolio volatility. We know that that many illiquid investments, not all of them, but many of them, have higher levels of volatility associated with them, even if that volatility is sometimes masked by what we talked about earlier, appraisal cycles or the lag in valuing privately held companies and so on. And so we know that the volatility is there, even if it's not directly observable year to year, quarter to quarter. And it's one of the reasons in our capital market assumptions that we have higher volatility assigned to private equity than we typically observe in a portfolio at any given point in time. And we know that volatility is the enemy of compound returns. The more volatile your returns are, even if they have the same average year after year over a 10 or 20-year period, if they're volatile, the compound return will be lower. That's just mathematics. And then the third risk associated with illiquids is they typically are fairly concentrated. Number one, and number two is they're particularly concentrated with respect to managers, and managers whose performance historically has had a very wide dispersion. So we'll look at that and we'll see how much wider it is than, say, the average bond manager or even the average equity manager. So let's talk about, let's move to forced selling at discounted prices. So what we wanted to do was to, and maybe a good place to look at this is page 5, we wanted to create a stress test where public equities, which we know to be the most volatile and have the biggest drawdowns of all of the asset classes, what if there was a very big drawdown? You can see that on page 5 in the upper right-hand side of 27%. And then we have another one just below it of 44%. What happens to the allocations to various asset classes in the portfolio? So you can see on the upper left-hand side the current target asset allocations with the bands associated with them. Outside of those bands, rebalancing is supposed to take place no matter what. And what you see is that that even declines of this magnitude, which would force allocations for illiquids because they then become a bigger proportion. They don't necessarily go up in value, but they become a bigger proportion of the total fund. You can see that if equity goes down by 27.4%, which has a small probability, but it has happened, your illiquid investments, which currently are about 27% of the portfolio, suddenly go to almost 31% of the portfolio, 30.9%. And similarly, if there's a bigger equity drawdown, then they go to 33.9%. So the question is, are those terribly unusual? And the answer is not really. You would still have enough liquid assets in cash, in fixed income, core fixed income, to be able to pay benefits for at least a year and not disturb your asset allocation and not have to do forced sales of the worst kind, which are having to put your illiquid limited partnership interests up for sale. So, so our conclusion is that these kinds of, on page 5, these kinds of declines are not sufficient to really put the fund in a position to have to sell depressed public equity. If we look at page 6, go ahead.
So, if I understood correctly, figure 3, you're saying we'd have enough cash to pay benefits for a year with the 44% decline, correct?
Not cash.
I mean, not
Cash and core fixed income would be available to take care of that, to take care of your liquidity needs without having to address selling public equity at depressed prices.
So then to go up to figure 2, can you say, okay, at a 27.4 decline, you'd have enough to pay for 2 years, 3 years?
We focused on 1 year, but you are correct. There are 2 aspects to stress testing for liquidity. One is how big is the drawdown in the volatile parts of the portfolio, and then how long does it persist. So if it were to persist for 5 years, it'd be a different story. But that has been very rare, that you would have a drawdown of this size. In fact, I think it's only happened, I suspect you would have to go to the Great Depression to find a drawdown that was persistent, was huge and persisted for multiple years. The great financial crisis didn't, as you recall. It was a V-shaped recovery. So then we asked the question, well, what if you ran, and we're on page 6 now, what if you ran your allocation to illiquid assets up to 40% from their current 27? And then we did the same kind of stress testing. You would expect that, that there would be a greater effect because more of the assets of the portfolio were essentially off limits. And the answer is yes, you do, but you still have enough cash, core fixed income, to survive without having to sell public equity. And you can see public equity is actually in the lower right-hand corner, actually falls below its targeted range. So this is a pretty significant decline, over 44%. It has happened. We've had 50% declines in. It has a low probability of happening, but again, it has happened. But you see that when we say that it could be dealt with rebalancing, you can see that you're still inside your bands for core and non-core fixed income and cash as well. So that you could essentially meet all your liquidity needs from those categories, and again, not have to sell public equity. Now, you may choose, under this scenario, to actually use some of it to add to public equity. But you can see that at 40%, if you have this kind of decline in public equity, your illiquids would approach half of the value of the portfolio. Again, the caveat is, if this were to persist for 3, 4, or 5 years, different story. But then the probability of this decline, we know that it has happened, but the probability of it being sustained for multiple years is even lower than this. You know, we never want to say never because the capital markets always surprise us.
Jim, just quickly, for benefit payments, we're looking at about 3% without contributions in. So you can run that core fixed income for a number of years. Now that grows over time, clearly,
Right.
but right in that range. So
Yeah, keep in mind that your net call on cash from the portfolio is benefits minus contributions. So it's actually a slice. It's not the whole thing. Yeah. And again, we don't want to be Pollyannish here.
And this is analyzing the net call.
Yeah.
The gross call.
The net.
Okay.
I mean, that's what we have in mind here. So I won't go into it, but we run it with what if you were starting point with 60% allocation to illiquids. Not something that we would advise, but as you can see, if you had these big drawdowns in public equity, you would still have meaningful allocations to core fixed income and to cash, but your illiquid, the portfolio would become very illiquid. And that doesn't mean that you couldn't pay that net cash drawdown that's required from the portfolio. But it's not something that we would recommend because the portfolio would be very inflexible at that point. So let's look at risk number 2. What about
Michael, you want to recommend it? You want to stay on it?
Jack wants us to stay on time.
Good call, Dan.
He would have a heavy burden on his shoulders if you were running a 60% illiquid portfolio. It might be one of those things where be careful what you ask for. So let's talk about portfolio volatility. Now again, volatility matters because again, it's the enemy of long-term compound returns. It is very opaque though, because it's very difficult to observe the underlying volatility in private equity investments, for example. So one of the things we tried to do, if you look on page 9, is we, again, took these various levels of illiquids and asked the question, do they increase the expected risk that is volatility risk of the portfolio. And if you look at the second panel from the bottom on the left, you see expected risk. You can see the answer is yes. Based on our assumptions, if you ramp up your illiquids, your expected risk to the portfolio ramps up along with it. Now, the realized risk doesn't necessarily ramp up though, because of the cushioning effect, the accounting sort of smoothing of volatility for private investments. And keep in mind, we're assuming that at 60% illiquids, you go from 30% domestic equity to 16%. And remember, domestic equity is a big contributor also to volatility. So, you know, the bottom line here is that if you add to illiquid investments, you will necessarily, we think, add to the volatility risk of the portfolio and do so proportionately as you increase the amount of liquids. But it will be very difficult to observe in practice because it's very difficult to unwind the volatility of the underlying private investment when it's subject to quarterly lags in valuation. It seems less volatile in the accounting than it actually is in economic reality. The third risk, which we would say is the biggest one, and I don't think either Ethan or Michael would disagree, is that in the illiquid space, the dispersion of returns among managers is much, much larger. And that creates a risk in and of itself. I mean, there's always a risk in manager selection. You might pick a manager that underperforms the benchmark and leaves you short of what you would get if you had invested in the benchmark, and vice versa, you could benefit. But the gains and the benefit and the risk in those situations is much different than it is in private investments. And you can see that on page 11. So let's take something where you currently have some managers that, while they have outperformed since inception, but recently they've underperformed their benchmark. On the left-hand side, U.S. mid-cap equity. Now, the difference between the top quartile and the bottom quartile managers in this category is 323 basis points, 3.2%. So that's meaningful over a long period of time, but it's not a huge spread. And for bonds, it's even less. And for core fixed income, almost all the managers are fighting, you know, to be 10 basis points, 50 basis points. If there are 100 basis points, we're talking about the entire spread of managers from first to fourth quartile. Now take a look at the right. If you looked at that same distribution of managers for private real estate or private equity, we're talking about 2,000 basis points difference between the best managers in the top quartile and the worst managers. What that means is that the work that your staff does in picking managers in illiquid space is extremely important, because a bad selection isn't just 50 basis points below what you might have picked. It's 1,000 basis points below. And so, you know, to sum up, if I could, on page 12, when we look at the risks associated with this type of analysis, and there are other deeper analysis we could do. We could try to string it out over multiple years. It gets complicated because we don't know how the board and your staff would react over time to a big drawdown. It's much easier to say, this is a drawdown, this is what happens, this is the consequence. But it's not a dynamic analysis. To do a dynamic analysis, we'd have to have scenarios about what you all would do in response to it, and there's any number of things that you would do. So to sum it up, if we were to look at the risk of illiquid investments, as Mark and you all have asked us to look at, we would say the first and foremost one is manager selection. Less true in other asset classes, but in these asset classes, liquid asset classes, very critically important. And you heard Ethan talk about talking to a manager for a number of years before pulling the trigger and making an investment. investing. That kind of due diligence is the kind that is very appropriate for addressing this risk. Portfolio volatility would be the next one. Because in some respects, because it's so masked, it has over time a greater penalty to geometric return to the portfolio, that's the amount of money you actually have. You don't compound by the average return, you compound by the compound return of the geometric return. And forced selling at this point is a risk, but of the three, it's the one we're least concerned with for the moment. Now, years ago when we did an asset liability study, we said that over a long period of time, as the demographics of the plan proceed, unless there are other changes, you may have curbs on how much of the portfolio you can accommodate being illiquid. But this is a snapshot of the portfolio as it stands today, and likely to be representative of the portfolio that you'll deal with over the next couple of years. Forced selling is a concern, but in likely effect of realized risk, adverse manager selection is a bigger one. So, Mr. Chairman, and that's the summary of this analysis. I hope you find it helpful.
Okay. I have a question, anybody else? So I guess, I don't know if this is, well, to you and Michael and Keith, is the difference between the top and the bottom performing managers in private real estate and private equity due to quality of managers or the wide range and the types of deals?
I'll let your
You understand what I'm asking?
Yeah, no.
It seems to me that a significant part of it's got to be due to the wide range and the types of deals, and there are certain types of deals we just don't get involved with because they're too risky, right?
I think it all boils down to manager skill, Carl, and that is, the types of deals is a part of that overall equation. You know, some deals may be riskier than others, and if the manager has the skill to execute on that, they're going to perform swimmingly. But if it's the same deal and the manager underestimates their ability to execute on that, then they're going to perform miserably. So I really think it boils down to manager skill.
Michael, did you?
And the types of deals which is rolled up into that. But
So you consider that all part of the same thing?
for sure, yeah.
So in other words, you'll look at any type of deal that fits in your bailiwick to look to see if that manager can pull that off.
I would say I have my own risk profile, so I'm not going to look at any and every type of deal that fits within my bailiwick. But to the extent I'm looking at something that is particularly nuanced, I'm going to make very sure that the manager that is doing those types of deals has a track record of being able to execute successfully on those deals.
Michael, anything to add?
I think your question is probably both for me. It depends on manager skill. But above that, there's different strategies within privates, different geographies, different market caps. That has an effect on the performance. So, I think in the privates group, we look at really everything. I mean, minority baseball teams, infrastructure, seed, venture, late stage growth, China, India, NPLs. I mean, these are all deals we've looked at in the last quarter. So that's why there's so much dispersion, because there is really a private strategy for any type of investment you can look at.
Right.
And I think that creates that dispersion. For something like venture, we're really looking for top decile. You need to be at that top because the dispersion is so great. For something like private credit, the dispersion is much tighter because everyone's kind of doing the same thing, so it's much more of an asset class return.
So I would emphasize the manager skill part of it. And while I can't prove this because I don't have the data, I would suspect that, remember, these are numbers not just for last year. These are numbers stretching over a long period of time. This dispersion is not a recent one, which means that it is highly unlikely that there's always a sector or type of deal that represents the kind of deals that fall into the bottom quartile. I think it's much more likely, as your staff has said, that there's a type of manager skill or lack thereof, regardless of whether or not it's in infrastructure or in private real estate or in China or wherever, that tends to fall into the bottom quartile. And like I said, I don't have the data to prove it, but when you look at sort of the value proposition of private equity or private real estate managers, there's a part of it that's associated with their investment strategy, which I think you asked a question of. Are they honing in on an area that looks promising? But the bigger part of it is, do they know how to buy and sell companies or properties? Do they know how to finance them? Do they know how to add value to a company that needs turned around? I mean, the value proposition is all about manager skill, or mostly about manager skill. So I think that's my best answer to your question.
Thanks. Anything else? Mark, did that, I hesitate to ask Mark if he has another question.
Well, that's unfair.
I know, but you're not here, so it's harder for you to hit me. All right.
Thank you.
Hearing none, we'll move on to tab 11, investment update.
All right. So investment update, tab 11, starting on slide 4. So all the retirement plans, so this is just the slide that shows how much did we add in value to the pension plans over the course of the last year, minus the cash outflows for benefits that we needed to pay. So obviously, as we talked about already, very good returns across the board in pretty much all the asset classes, so significant value add here to the pension plans over the last year. On the next page, slide 5, just another representation of that, but over some longer time frames, 1 year, also the 5 and the 10, and again, obviously, pretty significant boost to the overall level and funding of the pension plans over that time frame, as we've again talked about. The last 10 years have been quite good in terms of overall returns. Questions on that? Slide 6 just shows the returns for each of the pension plans here over the various time frames. All pretty tightly clustered, obviously, as they all participate in the same cap pool at this point. Just very minor differentiations there. Would note, you saw it in RBK slide deck prior, but the since inception date does go back to July of '94 here, so about just a little over 25 years for our since inception, and hitting our actuarial prescribed returns over the very long term, which is a good thing. Slide 7 is kind of just a different breakdown of that by the asset classes instead of the pension plans. And here I would just note that, at least this go around, we showed to you all of the asset classes we had over the course of the year. You see in the second column, the 12/31/19 NAV, you've got a lot of zeros there. That's because we put everything back into core fixed income. So essentially all of those, 6 other categories or asset classes, we rolled them back up into the core fixed income asset class. So going forward, we probably won't show that to you. We'll just roll it back up into core fixed income, and you'll know that we did that in the fourth quarter. And so obviously that's all completed. We're back in the core fixed income portfolio. We'll talk more about that in a little bit, I guess. Slide 8 is kind of the graphic representation of that, I guess, if you prefer the graph versus the numbers. But same concept here. All the changes in net value add.
So John, I have a question.
Yeah.
The numbers on page 4 are different than the numbers on page 7. The bottom line.
Yeah, so I had the same question when I was looking at this. So the numbers on page 4 include the cash at the plan level. So we've got cap, and then we've got the cash that's at all the plan levels. The numbers on page 7 is just cap. So the difference is that cash at the plan level. Yep. Good, I anticipated a question.
Nice catch, man.
Yeah.
That's a shock. Looking at the numbers.
Slide 9 is kind of a similar patchwork quilt that you see from RBK, but more focused on our particular benchmarks and how they performed over various time frames here. Obviously, as we noted the last year, very good returns across the board. See pretty much positive all down that column, but you can see it, things flip around from year to year as well, obviously. Questions about any of that? Okay, slide 10. So this is just where we are at in our current midpoints. So slightly overweight domestic equity, mostly more so in our core fixed income, a little overweight in international equity relative to our midpoint. As we kind of talked about core fixed income over a longer period of time here, and as we get opportunities, we'll hopefully come down. Looking to, kind of aspirationally put out the little bit higher midpoint for private investments, real estate in particular, and those will go up over time, but obviously it takes us a while to get money in the ground there and find new deals. But that directionally would be kind of how we would be heading. We're within the range across the board. I'm just trying to be patient and look for opportunities. Questions about where we're at currently, midpoints?
Do you want to touch on rebalancing and going forward, or would it be cash for?
Yeah, so cash, we've talked for a while about, we're having a bit of a higher cash allocation that's been coming down over time, not to steal Mike's thunder, because I think he's got a slide later on, but we're pretty much where we want to be, I would say, or very close at this point in time. So going forward, as we need to fund benefit payments in the next, several months, quarters, what have you, core fixed income is definitely going to be the place that we source that from. And
That's what's going to create downwards.
that's part of it, in addition to, we can't know, of course, but if the markets change and we got an opportunity in domestic equities or something, as an example, we can certainly possibly look to increase there, and Ethan and Michael are certainly putting, some bigger check sizes to some of the deals that we have been doing. So over time, that will reduce that as well, but that's a slow-moving process, obviously.
And I guess, in terms of private investments, real estate, natural resources, is that the thought process to bring those up is bigger checks?
Generally speaking, because we're looking to be more concentrated.
Yeah,
on
bigger,
managers.
fewer, stronger. And my personal philosophy is don't build an index and settle for mediocrity. We're in these asset classes to harness what we hope to identify as skill and information asymmetries and take bets accordingly and have conviction accordingly to generate alpha accordingly.
Same in the private investment portfolio. If anything, we were probably over diversifying, so moving to heavily concentrate the portfolio. And that will allow us more scale to build deeper relationship with managers. We probably getting to a sweet spot or strike zone with our managers and being an optimal LP in the view of a lot of our GPs.
Thank you.
Anything else on that one? All right. Next slide, slide 11. I will attempt to explain this one. So, because we have midpoints now, this is our attempt to show you how did we do in comparison to those midpoints, for the decisions that we made. Now, decision might be a stretch in some instances because, as we've noted, we have set the midpoints a bit high for private investments in real estate. So to the extent that those areas did well and we were below our midpoint, we didn't necessarily make a decision to be below our midpoint because we're trying to get there, but it will be reflected in the numbers here. So the strategic asset allocation number that you see on the left-hand side, so this is basically just taking our asset class benchmarks. If we were invested at the midpoint for our asset class benchmarks and how that performed over the last quarter in this instance, we would have gotten 5.73% return, okay? So you can see next to that then the tactical asset allocation was a negative 14 bips. That's because some of those were below the midpoint on some of those asset classes. And Aaron, on slide 13, Aaron kind of provided some bullet points here as to, what drove that. So we're overweight international equities, core fixed income, and cash. Obviously, as Jim talked about earlier, international did well, but not as well as domestic equities. Core fixed income did well, but not nearly as well as equities or most everything else. And cash, of course, not a huge return there. So to the extent we were overweight those and underweight other areas that performed well, that leads us to a slightly negative number in terms of our tactical asset allocation. Our style selection would be if we looked at the underlying manager benchmarks rather than our asset class benchmarks. So to the extent that we were, for instance, in, I called out the commodity index earlier. So we saw the significant underperformance we had in our natural resources versus the commodity index. So that was a big red number that we talked about a little bit with Jim. So it treats that as a style selection. So we could have, it's saying, if we were invested in that commodity index rather than whatever our manager was invested in, was that a good or a bad decision? I'm kind of saying in this instance, I'm not sure that's a real good match to what we have in the portfolio. That's, but that shows as a negative manager selection in that particular instance. So as Ethan noted, Alarian, our MLP, was down 4%, while the Ackley Commodity Producers Index was up like 8% over this time frame. So, pretty big swing between those two as an example. And then manager selection, so that just comes down to, the additional return we earn by investing in the underlying managers rather than that manager's benchmark, so that the manager beat their benchmark versus, did they beat their benchmark essentially. And so in that instance, a lot of that was due to one of our small cap value managers here. So again, on slide 13, what Aaron put out, Von Nelson, if you go back and look at that, they were a little bit under their benchmark there. So if you look at slide 12, and this is a question I guess I have for you, this kind of shows the detail of each of those, the strategic, tactical, style, and manager selection. I kind of looked at this and thought, well, maybe that's a bit much in terms of the overall detail that we're looking at here, and maybe it's a little easier just to look at kind of that top line, slide 11 and slide 13, but to the extent that you find it useful, we can continue to put slide 12 in there. slide 12 is kind of where some of the detail stuff comes from, and I think I like the bullet points that are on slide 13 better as to call out, well, here's why within each of those, but your call is to whether you want to continue to see that. And you don't have to tell me right this instant.
I'd like to look at it a couple more times
Okay.
to get used to it
Fair
and
enough.
see if
Yeah.
it's useful.
I'm kind of getting there myself as far as looking at this and to see how
The
it goes.
bullet points, I mean, I think.
The bullet points are,
Yeah.
yeah, for sure, because I think that is the easier place to call out and say, well, here's what's going on. So if you look through the detailed slides here, the scales are different for one thing within each of these. So obviously, when you look at that first slide, tactical and style, we're not real big drivers. You look at the manager selection, the big driver here is private investments. And again, that is really, to me, just the benchmark mismatch that we continually talk about for privates, and that's what's really driving that.
Go half an hour, we're done.
Yeah, nope. Such luck. So, any other questions on those slides? All right, we'll keep plugging away on those as we go forward.
I have a question
Yeah.
for you. Is, maybe not the slide itself, but is the data that's reflected on 11 and 12 and 13, is that useful to you?
It is. I think it's helpful to see, I think, like I said, I think it might be an overstatement to say that we made a decision, particularly within a quarterly time frame.
Right.
Most importantly. We made some decision to overweight or underweight a manager, make a tactical move or whatnot. But it would show you, for instance, if we did make a big tactical move, and, that might be reflected here, that was a good or a bad decision. But I think probably for me, the more interesting will be as we start to get to more long-term numbers with some of this. I would rather, I don't think of a tactical decision as being even a quarterly. I would rather see this over at least a 1 year, if not much longer time frame, so that we can, then I think we get a better evaluation of what we may have done in time.
But I just want to say that, these are your slides going forward.
Yeah.
So if you want to change any of these or add things or subtract them, that is meaningful to you,
Yeah.
that would be helpful, I'd encourage you to
We
relook at
we will
these.
change and add and subtract them, quite certain of that.
Maybe just quickly, this for the board is where you would see those instances of deviation from the strategic asset allocation. So
Right.
that's
That's what's driving the slides. Exactly. Absolutely.
And if I might, you asked the question, are these useful to John and the staff? I would suggest that the first two bars on the left on page 11 are useful to the board. Because one, they drive home, the first bar drives home how important the asset allocation is. And then if you did nothing else, this is the return you get. So changes in the asset allocation have a big effect. The second one is it's a way of, you have a delegated model here, and if you saw tactical asset allocation being a highly volatile and big contributor, it would mean that your staff is deviating in meaningful ways in their management of the cash flow from your strategic asset allocation, and whether or not it was helpful or harmful. So those two, I think, are very useful to you.
Okay, thank you.
So slide 14, just the individual returns for each asset class. I think Tim handed out an updated slide here because private investments wasn't on the one that was in the book. And I had a 13% return, so Michael really wanted to show that to me. I'll leave him out. Questions about returns anywhere there? Slide 15, so cash, as I mentioned, at the end of the year, come down to about 2.5%. It's probably close to 2 right now. In fact, Mike just gave it to me today, it's about 2. Risk management, dashboard development, yep, we're already talking about some changes there, so more to come. Dan had noted on this that MPARA TRS reports out in the next couple of weeks here, I guess. And then obviously per the new trust fund policy, we'll be working closely with Ethan to figure out how we make those changes for real estate within trust fund in particular.
So the pension fund report, will that show new expected return or anything from the actual?
What the pension fund report will be is I'll just be presenting the annual report to the individual pension boards, what we're required to do under statute.
Other questions from me? No. All right, I'll turn it over to Dan.
Good morning, Chairman, board members, site members. I want to start on page 16, and this is a new slide for us. The purpose of this slide is to give a visual representation of the valuation ranges for all of our benchmarks that are assigned to each of our asset classes. So this is kind of an overview, if you will, at a very high level, where our valuations stand for each of these MSCI benchmarks, and there's a couple there for fixed income as well. I realize that the graphs are pretty simple, and that the numbers aren't there to aid you, but that's where there's a little bit of a self-explanatory here, and then plenty of room for improvement. Because we would like to show some additional valuation slides and things like that. But for context, it's important to understand that, where this data came from. So I'm getting my price to earning, a typical valuation metric from MSCI. This is our benchmark provider. They have, they calculate a PE for each of their benchmarks monthly, and they go back, basically a long time because they back tested, things like that. And the point being is that this data series is the longest that I can grab from MSCI. Sometimes it's 30 years, most of it's 25 years, and then when you have these thematic indexes, such as what we have for natural resources, the commodity producers index is really only about 6.5 years of data. And you have to clean it up a little bit because you get negative valuations in there that will throw off these graphs. But it's important to remember that this is long-term in terms of a graphical representation. And this type of a box plot is just showing you the lowest valuation that you would get over, say, 25 years. What's the highest? And I could fill you in on those exact dates. But, basically your low valuations correspond to recessionary periods. And then the high valuations is just associated with the market peaks of the general market. The other viewpoint here is that, again, the blue band, if you will, is the median or the average. I'm just going to, for simple reason, I'm going to call it the average. And then that gold band is where we stand currently. And again, so this is important because the perspective is, and out there in the investment community is that, and Jim mentioned this yesterday, that there's typically with valuations, there's a reversion to the mean. That when you have a long enough data series, that there's a central tendency for wherever you are currently, that's going to move closer to where your averages are. And in this case, you can actually build an investment strategy, right? This is where the typical value manager would look for those securities that have valuations well under the average. And if they, there's other facets that go into it, such as the prospects of that security or the growth of that security, that I'm not really going to touch on. But the value manager is gonna buy something undervalued with the hope that that valuation is gonna move up to the average. And again, you know, likewise, if the current valuation is above the average, and let's say it's above meaningfully, and by that I mean, I can draw a line that say, and most of these are not within the extreme percentiles, a 90th percentile or a 10th percentile, but when you get valuations, current valuations on the end of these ranges, you know, the tails, that's starting to indicate that there's, you know, there's either increasing risk with that benchmark, or if you're on the low end of the valuation, it could be a very big opportunity. So both of those extremes you're looking at, and it could very well be just an outlier as well. But investment managers build their investment strategy exactly around the movement of these valuations. And again, that, you know, the other caveat here is if you just look at real estate, for example, that's a price to cash earnings. I needed to do this. I wanted to get a common denominator when you look at valuations across all these asset classes, but it's just, the data is there, and then MSCI makes provides the cash earnings because the high depreciation in real estate, it makes the regular earnings kind of very depressed, and therefore a regular PE for real estate is just way too high to make sense of it. It actually looks alarming when you look at real estate at a 45 multiple, but that's not. A better metric is this price to cash earnings. And then mind you, you know, this is the type of discussion that we need to start with all the directors as well, because they're going to have some even finer valuation points or their favorites, such as with real estate, it's going to be cap rates. So the other point I want to make here is just that in fixed income, which is the bottom two lines, you know, I'm trying to represent something for core fixed income and non-core. So that's investment grade and high yield. So, you know, a corporate OAS, that's not our index for core fixed income. It's really the U.S. Ag. But that benchmark has, I don't know, 40% of treasuries in it. And so treasuries, by definition, doesn't have a spread. It's just a risk-free security there. So the spread for the U.S. Ag is pretty narrow, and it just isn't representative of the risk that we want to reflect in terms of valuation. And again, my observation here is that, you know, we're using corporate OAS, which stands for option adjusted spread. And this is that. This is the additional compensation you get when you own an investment grade for that credit risk that you're taking above U.S. Treasury. And again, these ranges for these fixed income asset classes, they're a little bit wider than what you'd expect, and that's in part because spreads really widen out in the great financial crisis. I mean, I don't think in our lifetime we're going to see an 1,800 type basis point spread for high yield. Maybe we're going to see it again, but it's really amazing to look at how wide some of these spreads happened with the great financial crisis, but that's my other point. Valuations get really cheap at times when you know, we're in a recession. So it's just one of the things that's going to show up on the risk dashboard is just what is that assess? What is the probability of the next recession, and when is it going to happen? If anyone has a crystal ball that doesn't have any false positives or false negatives as to when the next recession is going to happen, we are all listening. That's absolutely all ears. But so let me just stop there and just see if does this make sense, and I can provide some context in terms of the dates or, you know, what exactly the averages are. But
questions? Okay. Moving on.
Yeah, so my next page, just to comment quickly on, is our pension liquidity. So this ties in with what Jim was trying to explain, and this is looking at our pension liquidity across the entire portfolio. So this doesn't matter in terms of whether the cash is at the retirement plan. It doesn't matter whether it's at cap. we look for any kind of type of cash that's available in the pension fund, and then we basically assign it a liquidity profile here. And of interest of mine is that what is their one-day liquidity? So this is showing you the different components where it comes from. We're at a 15% of the overall pension of daily liquidity. Okay, you run the numbers on 12 billion, you're going to get 1.8 billion of liquidity on a daily basis to satisfy what we talked about, which is our net pension benefits that we're going to be paying on an annual basis, and any type of unfunded commitment for private equity or any of the illiquid investments that we have. And then you can quickly see that our illiquids is about 23% of the portfolio. So 27% is our midpoint, but currently we have 23% or about 2.8 billion illiquids. So again, I like with the information that Jim provided, but when I'm checking these numbers, I have my own 50-50 model. And this is talking with kind of an inflow-outflow effect, and it goes something like, if you start with this is a static analysis now, but if you start with in the ground, how much you have in illiquids, you can assume that 50% of that is going to be unfunded commitments. That is going to be, you're going to have to make a payment when those unfunded commitments you get a capital call, essentially. And you can assume that it's not really necessarily a normal, but it's possible that your unfunded commitments could be called 50% in year one. We haven't had that in a long time, and typically an average is 40%, but just for my comfort, I use 50%. And then I can translate that into, okay, that's the minimum liquidity that I need, $800 million if you follow that through. It's really kind of simple math because it's 25% of what we have in NAV. But it gives you a reference point that we do have in terms of daily liquidity. We have plenty of liquidity for the current portfolio, and then you can do the same thing if you want to look forward. But to Jim's point, we do have enough liquidity that on a daily basis that we're not going to incur this forced selling where we might be needing to sell, say, public equities to fund a capital call for private equity. Any thoughts there? Okay, my other pages are pretty standard in terms of our geographic exposure. And that hasn't changed much. Our top 10 managers, that's looking at our concentration. And then on page 20 is again our pension holdings by issuer. This is pretty much the same. I would observe that in this top 10 holding, most of these, other than treasuries and agencies, most of these securities we own a fair amount of equity plus a little bit of debt. It just kind of it's the way you roll these numbers up that we have that little bit of that overlap, and I think I'm fine with that. So the only other thing I was going to say is that, again, it's back to the typical Jack's question, where do you see the most risk? And I think it's with this portfolio, it's pretty straight. Our risk is coming from our equity exposure, right? It's coming from, we have a bias for U.S. equities. We have a bias and a commitment to increase our private investments. And both of those areas definitely represent a risk in terms of what you look at it in terms of, again, what Jim mentioned, illiquidity, concentration, leverage, and a geographic exposure.
Okay, anything? Thank you.
Morning, Chairman, members of the board.
Hi.
This is a new slide that we've put together to outline where we are in terms of our cash balances. So the top portion of this is a table showing the cash balances that we're monitoring on a day-to-day basis. And it goes back to July when we started a review of where our cash balances were and some open discussions with the cabinet, eventually with RVK, and then we developed some targets. So basically our target has been 0.75%. Back in June of last year, you can see we were at 2.97%. And what that represents is the amount of STIP that each retirement plan to own. And that's where we were as of June 30th of last year. In July, we started this discussion, and then we decided, okay, eventually, over time, we were going to move towards a 0.75% allocation to STIP for the retirement plans, 99.25% of cap. So that's what that top number represents. So you can see that slowly going down over time as we rebalanced on a monthly basis. When we had pension payments go out, we put this together and we slowly reduced that balance down. I can report that, the first bullet down here, as of in January, we reached our target of 0.75%. So that's where we're holding fast at this point. The second point, or the second portion of this that we look at is the cash asset class. So within the cash asset class, we have State Street STIF, which is very liquid. It's kind of a one-day thing. Money sweeps in and out of that vehicle based on interest payments, purchases, and sales, etc. That sweeps on a day-to-day basis. Also within the cash asset class, we have STIP. So we actively buy STIP within that particular asset class. So you can see here, as of 6/30, we had about 0.36% in STIP. 2.59% in STIF. So you've heard us talk about that over time on how we flipped that. We've actually, if you look at it as of 12/31, we're at about 25% in STIF and 75% in STIP. And that's because there's a management fee portion of STIF, as well as we can go out a little bit longer in duration on the STIP fund. So we're getting a better return there. So basically, if you go from 6/30 to 12/31, we reduced our balance from cash for the plan and the asset class from 5.92 down to 2.55. So we're pretty much very close as of 12/31 where we wanted to be. And these are just graphical representations that kind of show the gradual decline in some of the movements that we've made within the cash portion.
Can you give me a ballpark number, dollar-wise? Okay, when it was at 5.92, what was in cash?
I'll have to do the math.
Sorry,
No, that's okay. I'll do the math and I'll give that to you.
No,
As of right now, let's just look as of yesterday, and maybe we can do the math there. So, as of yesterday, we were at 2%. At 2.02% as of last night. So that's roughly 3 times, and the 2.02% would be 146, 250, so probably 500 million.
So decline in what's in cash?
We declined about 250 million. So the 6% was probably likely about 500 million in cash. So as of yesterday, we were at 0.85% for the plans, because we rebalance at the beginning of the month, we get contributions during the course of the month. At the end of the month, we rebalance back to 0.75. And we were at around $146 million, $146.5 million, which was 1.17% for the cash asset class. So this is really to kind of give you an indication of kind of where we started the review in July, the decisions that were made and the actions that were taken to get us to where we want to be. So if you look at the plan and asset class cash together, our target for the asset allocation is 2%. Our range is 0 to 4. We're right at 2%. As of last night, 2.02 for the total there. And so that's pretty much where we're going to try and hold it from there. Other than that, I think we reached our targets a little bit faster than we anticipated, so that's good. Other than that, we monitor this on a daily basis, on a weekly basis. I present the numbers to the cabinet to kind of see where we are, if we want to make any changes, and so forth. So other than that, we've got a number of little projects that we've been working on, kind of on the fringes. One is looking at different cash vehicles in State Street. You know, Stiff is a daily vehicle, but it has a deadline early in the morning. There's some late cash flows in the late afternoon, so we're trying to get some of that fringe money, though we might have a security fail. Talked a little bit yesterday about how we don't pay the broker until they give us the security. Well, if they don't give us the security by 1 p.m. Montana time, we don't give them the cash, but it's too late. So we've worked out a deal with State Street to have a late day vehicle in order to invest that money and things like that. So we're kind of monitoring this, rebalancing on an ongoing basis to our targets, and then trying to find other ways just to earn a little incremental interest on the fringe. So with that, I'll answer any questions.
Anyone?
All right, thank you.
I'm on page 22, private investments, market environment. Generally, fully valued market environment. We've seen some cooling off in 2019 compared to 2018, which were at some peak records. 20% reduction in number of deals and deal value. But I would say that's a pretty big haircut, but I would say valuations are still fully valued for buyouts. That's really driven by cheap debt, and you can see on the third bullet point, leverage for buyouts is still at 5.9 times. That's driving the valuations upwards. I would say overall our portfolio is positioned well. There's always been a value slant in our portfolio, and we've been very stringent in looking at new relationships and the valuations they're buying at. I would say in general, we've been very focused on value investments rather than just growth, especially in this high valuation environment. Page 23, performance. Not much to say there. Performance has been strong over a long period. Page 25, some of the portfolio stats continue to be focused on buyout and venture, and being very selective there. We'll continue to increase our allocation to credit and continuing to look at sector specialists. We're in the late innings with a sector specialist now. You'll see that deal in the next board meeting. It's been a pretty busy 2020. January was very busy. We're doing a lot on sites. We haven't closed out the deals quite like Ethan's team, but we should expect 3 or 4 more deals in the next board meeting to be presented. So that would be 4 or 5 deals that we would have done in 2020. So through Q1, we would have allocated about half of our pacing for the year. So it'll be very front-loaded. That's really a function of the legacy portfolio and our existing relationships, and us just giving preference to our existing managers and doing the work early on before we're looking at any new relationships. So it's been a very front-loaded 2020, similar to 2019.
So are you saying that means that then later on this year you'll be able to start looking at new managers?
We're looking at new managers now.
Well, I assume that, but I mean, that's where, we would expect to see them more in the second half of the year.
Yeah, more so. We'll see some in the beginning of the year. I'm really trying to say that for every new manager we're bringing on, we're likely saying no to an existing manager because we have such a large legacy portfolio and relationships there. So and we are trying to be fairly pragmatic around the pacing and not over-allocating in a high valuation environment.
Thank you.
Cash flow, negative 12 million. That's fairly expected. I've indicated that our portfolio is really at kind of a cash flow break even because of the historical investments. 2019 tailed off on distributions a bit, kind of in line with kind of deal activity. I would expect our cash flow profile to be negative moving forward as we are in the J curve of ramping up the privates portfolio. So I think that number will likely grow over time. And then the commitment earlier that we mentioned, Ascendant. Another focus for the back half of the year, it's still early days, is we're starting to look at more European managers. We don't have a lot of European exposure in the portfolio. It's something we're considering to diversify the portfolio. They'll never quite be to the scale of our U.S. portfolio, but you know, some possible benefits in having some European exposure.
And what are the barriers to complicated things instead of starting a new geographic focus?
Yeah, I think it's, we haven't spent a lot of time there. And so it's developing new relationships, a little bit of inside baseball. I'm going to a conference at the end of the month in Berlin, meeting with 20 managers there. So 10 of them are the largest European managers, and then the other 10 are more managers that we would typically see in our portfolio, smaller managers, niche strategies, not large investment managers. So we're doing a little bit of landscaping, developing relationships, seeing what access is like. I think generally it's been pretty good at our size. We've kind of hit a sweet spot where we're big enough to be meaningful to some of these larger managers, but not so big that we're taking up all of their capacity. That's something we could face in the future as we write larger checks, is, you know, a $500 million fund doesn't want to have one LP that's $100 million. And maybe they'll have that, but it's probably going to be with an existing LP of theirs. And so we're kind of entering that situation now with some of our existing managers that perform really well, and us trying to scale up and get our allocation wants. So that's something we'll deal more and more with moving forward.
So when you visit with these people at this conference and whatnot, that's just giving you an idea of who you want to pursue further as potential managers? Is that what you're?
It is. Yeah, we have the marketing decks, but you know, to Ethan's point, it's really about the people. Trying to get a feel of, you know, how committed they are. You know, we're thinking about the long-term relationship. And, you know, we tell people we're looking 3-4 funds down the road. Are you going to be around? We're not chasing specific funds. We're more interested in partnerships in the long term.
Yes.
My question, I remember when we were getting involved in individual publicly traded equities in European and other markets. And I know that it caused accounting a lot of difficulties. Is that true in this also, or is that not an issue? We had to be registered, do you remember we had to be registered in Turkey, and there was...
That was more for the 130/30 type fund stuff I think you're referring
Oh,
to, so
okay.
it would be different.
Okay, and what about currency risk on this?
So there could be some currency risk depending on the strategies. Some are US denominated, some are Euro denominated. Depending on the strategy, maybe more of a trading distress strategy, they could hedge that out. Maybe for a more traditional buyout, they would just leave it in currency, the euro or the pound. So it really varies on the strategy, but definitely currency is always a risk when looking at international managers.
Anything else? Thank you, Michael.
Thank you.
Members of the board. I'm on page 25, looking at real estate. I'll just direct your attention to the final bullet point there. You know, fundamentals are still healthy, though moderating. Debt's widely available. Deal flow remains robust and healthy. We did $800 billion in commercial real estate globally last year. REITs performed well. CMBS issuance was up, and they expect increased numbers this year. Dry powder remains high. Fundraising is healthy. Folks continue to increase their allocations to real estate. There's a lot of competition out there keeping valuations stable, though going forward, they're going to be more income reliant. Cap rate compression is going to be less pronounced in the years to come. Happy to answer any direct questions with regard to what's happening in real estate. Okay. Page 26 is our performance, both on an absolute return basis and relative to the benchmark. If there are any questions there, I can address them. Otherwise, we can move to the more exciting page 27. So again, on page 27, North American centric portfolio, not looking to map global real estate GDP anytime soon. I believe member Fladno had raised issues around, or questions around Asia, which I believe I addressed last time. But, you know, for the longest time, sort of struggled with that equation, thinking maybe we should go over there and take advantage of that growth story. But the more I look at returns over there, the more I'm convinced that there's no real need for us to be there. There's any number of additional risks, and we're not getting paid for taking that additional risk. So as long as we're still the largest, deepest, most liquid, highly adjudicated commercial real estate market in the world, there's no reason to go jump overseas and start deliberately building out significant Asia or even European exposure. My view on Europe is a little bit different than some others perhaps, but I think they're sort of muddling through and there's not a whole lot of reason to be there.
Is there a total asset value above which you should be in Asia or some other place? Understand my question?
I believe I do, and assuming I understand what you're saying,
I mean, do we reach a certain size where even though you're not convinced that's the best place to invest, the prudent expert would say you need to be diversified into those markets?
Yeah, my personal philosophical bent is that number doesn't exist. I still think we can be just as diversified right here in the good old US of A. So as we've talked about in the past, it's broadly diversified, continuing to focus on our core high conviction names and operators. One thing I want to really point out here and spend some time with you guys, assuming there's additional questions, is this bullet point number 5, beginning to look at separate accounts for longer duration holds and cash flow. So the more I think about sort of portfolio construction and innovation and incremental evolution, the more I came to this conclusion that, you know, the whole real estate industry and these closed-end funds is geared towards trading your value. You know, you create a lot of value and then you trade it away. You create a lot of long-term durable cash flows and then you trade it away. And that makes a lot of sense, right? You want to realize your value at some point. But in the context of our fund, a perpetual vehicle, you know, if we can create prudent diversification with moderate leverage and generate a long-term durable cash flow stream that is 100, 200, 300 basis points accretive to our actuarial rate of return, that is, you know, 8, 9%, why would we ever trade that away? Why wouldn't we just continue to manage that and continue to collect those income streams through time? And so, to me, that makes a lot of sense. And so I've begun to have conversations with some of our high conviction, vertically integrated operators who have the property management, the leasing staff, the asset management, have the acquisition, disposition folks, the folks that, the construction folks, financing folks, who really have the platform to manage assets long-term on our behalf. And there are benefits, in my mind, in addition to the ones I've mentioned. There's more control, there's lower fees, there's knowledge transfer.
Are
And
they
so-
doing that for other people?
In some cases, sure, yeah. Separate accounts on the real estate space are not unusual by any means. In fact, many of our brethren have nothing but separate account relationships and don't invest in funds at all. And so while I think for the immediate midterm future, we will have funds and will likely continue to have them, maybe longer term, like 15, 20 years out, assuming, you know, things go according to plan, we may be out of the fund business long term. I think it's well worth delving into, and I think it's a much better way to manage a real estate portfolio longer term. Now, I'm not saying that I'm going to be the one managing those individual assets. We're hiring people who have the expertise to do that and manage it long term. But if we can generate these long-term, prudently diversified, durable cash flows that exceed our actuarial rate of return, I don't see any reason why we should trade that away. Now, the question may be, well, when do we get our money back? It's a good question. We get our money back through ultimate realization, long-term, down the line, 10, 15, 20 years, but we also get it back in the form of that 8% current net operating income distribution that pays down our initial cost basis through time, pays off our debt. Maybe we ultimately, you know, we pay down our debt, we have an unlevered equity investment, then we get all of our equity back through this income distribution, and once we pay ourselves back, we just accrete on top of that original cost basis of the investment. And there's nothing that says we can't ultimately sell it at any time. Yes?
So doesn't O&M increase as this real estate ages and stuff? I mean,
I'm sorry?
O&M, operation and maintenance of these types of, I'm just thinking of as things get older, having worked at a college that had 100-year-old
Yep.
buildings.
Yeah, so that's a great question, and selling in the face of functional obsolescence, for example, is a great reason to sell, or foreseen functional obsolescence, but part of what our real estate managers do in our funds, and in addition to, you know, a separate account, is maintenance CapEx. And there would be, just like in the funds, an annual process where you create a budget, and you know what your revenue streams are vis-a-vis your lease payments, and you look at your expenses through time and you come up with reasonable numbers to manage operating and maintenance expenses, so as not to generate outsized deferred maintenance and ultimately detract value from your underlying investment.
But oftentimes you can't prevent that because there are going to be major O&M costs, you know, that are kind of cyclical. It might be 5 years, 10 years down the road, but you're going to have those big lumps, and then our earnings, of course, would
Sure. Yeah.
increase during those periods.
Yeah.
Go ahead.
But when you look at sort of the life of one of our funds and think of the turnover in a 15-year period, let's say if that's the life of the fund, what would that turnover look like in a separately managed account over that same 15 years?
Maybe I'll just level set. Most real estate funds have a finite life of 7 to 8 years. So 100% turnover in a 7 or 8 year time frame, assuming they do what they say they're going to do for the terms of the contract. Oftentimes it's not the case. They build into the contract 1 or 2 year extensions. Sometimes, you know, they'll extend beyond that. So in the case of a separate account, the cool thing is you get to create the terms of the agreement from scratch. And so you could create them to mirror a fund term, a typical closed-end fund life, or you could keep it open in perpetuity. And you could hold those investments for perpetuity, or you could sell them through, you know, over a seven-year period and then fund that separate account with another $100 million, let's say, and then rebuild it and then sort of cycle it in and out. Or you could just say, here's 150 million, and this is sort of what I'm talking about. Go invest in, you know, let's call it, for ease of numbers, let's say we're going to allow 50% leverage on a $100 million equity investment. So you have $200 million of buying power. You go buy 8, 10, 12, 15 deals. You create value through pushing rents, increasing occupancy, et cetera. You generate that 8, 9% cash-on-cash yield through net operating income, and you actively manage it because, leases will expire, there will be operating and maintenance CapEx that detracts from your overall net operating income, and sort of that ebbs and flows. But if you can sort of maintain that through time, what I'm saying is, why would we trade that away? It just doesn't make sense to me, longer term.
And the managers who do the SMAs would sort of buy into that idea of, we may own these properties for 20 years.
Yeah, no, this isn't novel by any means. This has been tried and true and existed for decades. So I just wanted to preview that with the board and let you know what I'm thinking, because I think it makes a whole lot of sense. It also reduces frictional cost of staff's time and energy in sort of sourcing new deals, underwriting new deals, bigger, stronger, deeper relationships, knowledge transfer, more depth, less breadth. Yes.
It sounds more and has to feel more like a trust fund investment in the sense of, hanging on to something, living off the income.
Yeah, definitely.
Does that enter into your thinking too? Now that we're increasing the trust fund?
So, yes, I think that is a worthwhile statement and accurate in that what I'm talking about is not funding a manager to go develop multifamily, go take entitlement risk, construction budget risk, change, override risk, et cetera. What I'm proposing is buying core plus-ish assets that are operating, currently cash flowing, may be priced below market, may have current rents in place that are below market, and actively managing those to grow net operating income, stabilizing it and holding it longer term, more like a bond holding, if you will. Yes.
Okay. And the other question I had is, does that give, do we want, and does it give us more control over the decision-making process?
Absolutely. Okay. We get a hand in drafting the documents, and all the governance, hold, sell, buy.
Right.
I mean, it will not be 100% discretionary. We will be involved in, budgeting decisions, hold, sell decisions, buy decisions.
So how does that reduce the time?
Well, that's my question.
So, I think initially, Jack, to your point, it will probably increase. But once it's established, it's sort of quarterly meetings, it's property reviews, it's annual budget reviews. It becomes more hands-on, but it grows the concentration of the portfolio as far as relationships. And so I think initially there'll probably be a ramp, but then it'll sort of stabilize and it'll settle out.
Do other funds that do this have somebody that's sort of dedicated to this as sort of different from deal sourcing and that kind of thing, or somebody more? Sounds to me like you're going to get into more management.
The folks that are doing it, like Utah, for example, or Wisconsin, or their entire staffs are dedicated to this. So that's all they're doing is doing diligence on managers, and then entering into, separate account relationships that are sort of specific to them. I imagine there are plans out there that have folks that do nothing but funds, and then maybe folks that do, go buy and manage the real estate themselves. There are other models where folks don't do separate accounts, and they actually go buy and hold real estate directly on their own. They've got people who have the expertise to own and operate and manage the real estate.
Are you ready, Dan? Well, now you only have one job now, you can take.
It's true. It's getting bored in the last 3 hours.
So, other questions?
And just out of curiosity, how do you envision that coming up? I mean, now you're saying, I'm thinking about this, appreciate that, you got a lot of questions. No one said, geez, this is the worst idea we've ever heard of. Is the next step that you would come and say, we're gonna start really?
The next step, honestly, is to present to you in April a redefined investment policy statement in real estate. And it won't be a wholesale change, it's not going to be a complete rewrite, but it's going to address specifically the sizing. Because, I don't want to fool any of you, you need to make larger bite sizes in order to achieve prudent diversification. So it'll contemplate something similar to natural resources, where instead of on the asset class level, it'll contemplate individual size limits for a particular manager with respect to cap. So I think the natural resource investment policy statement now says no more than 1% of cap in any single name within natural resources. I'm going to propose 2%. In order to give us the flexibility, i.e., $150 million of equity with some prudent, moderate leverage to give buying power to achieve prudent diversification.
Thank you. We'll move on.
So, okay. As far as leverage constraints, we're all good. We've talked about the commitments, negative cash flow, a big number, but we were really active investing a bunch of cash, $30 million extra in this Fidelity Rehi, $40 million in American Core to right-size it to our other core mandates. But other than that, we can move on to natural resources if that's okay. So again, I won't go through these bullet points, but I'll bring you down to the key takeaways here. Oil prices remain relatively range-bound. They have sold off of late. Some of that was U.S.-Iran issues. Some of it's been coronavirus, but OPEC continues to discuss production cuts in order to address this oversupply situation that we have discussed earlier. U.S. production continues to grow. We continue to grow our exports. The fundamentals as far as growing the molecule base, oil and gas, balance sheets, the fundamentals for MLPs remain very strong. They've been caught up in the overall sentiment, but the index relative to the Alerian index relative to the exploration and production index drastically outperformed. So hoping for this reversion to the mean longer term. Log prices remain depressed. The housing market is showing some signs of a rebound. The fundraising market remains steady and healthy. Questions?
Oil prices range bound. Just give
So-
me a simple,
50 to 65, and it just bounces around in there. There hasn't been a dramatic breakout to the upside to reach 80. There hasn't been a dramatic breakout to the downside to 25, for example. I think we touched upon performance earlier while Jim was presenting, so we can skip to page 30 unless there's questions. Again, North American centric, the broader natural resources portfolio is growing vis-a-vis the mitigation banking strategy that we talked about earlier, and then the aggregates-based strategy that we talked about a few meetings ago. We're diversified in energy, we're diversified in timber, the portfolio is continuing to diversify. We're continuing to look for other strategies outside of energy, specifically It's a very energy-heavy exposure to continue to diversify that away. Cash flow is negative. Big capital calls drawn down from recent fund commitments is what's driving that. You see our commitments here that we spoke about earlier. Leverage is well within constraints of 0 to 30% in timber. Any questions? Okay, thanks for your time. Appreciate it.
John? All right. We're running a little late, so I'll try to go quick. Core fixed income, as we said, rolled everything back up together. Jim mentioned a few times, Treasury curve has indeed been very flat. We've gone down about 100 basis points across the curve over the course of the year, so that 9%-ish return that we got, if our duration was, say, 5.5 or 6, you can think we probably got a 5.5–6% bump just from rates going down this last year. So the majority of that 9% is just market value increase, and the rest of it was a little bit of yield that we're getting off of fixed income still. Inflation, fairly subdued, particularly the way the Fed looks at it, so we haven't seen anything too dramatic there. Spreads pretty much across the board have been pretty darn tight, definitely towards the low end within corporates. That's not been much of a change. We've been more attracted to adding a little bit more to securitized and mortgages in particular, just because relative value-wise they look a little bit better, and at least we're buying something that's AAA versus some kind of credit risk associated with that. Markets have been open and healthy and functioning well. Good volumes. Corporate issuance, of course, remains strong as all the corporations take advantage of the extremely low rates that we've had. Questions on the environment within fixed income? Returns, nothing much to say there other than doing well. In terms of the details around the portfolio, so as we put everything back together, as I've noted before, we're not really in the place where we probably would want to be, so a lot of rebalancing taking place in December. I had the numbers now, I've forgotten, but about $200 million, I think, that we sold essentially within Treasury and TIPS to kind of reallocate into primarily probably mortgages more than anything else, a little bit into corporates, and then some, I should say, into long Treasuries, because we were an intermediate benchmark. We went to back to the ag benchmark, so rebalancing that a little bit as well. That continues. So we did well in December as we had a little bit of a sell-off there. That worked out well, but then we immediately kind of got back to the risk-off. Treasuries rallying, not really what we would have preferred, and that kind of continues to this day, so we're trying to be patient, but we're still kind of under-yielding the index, as we say, so we're not in as much spread product as we typically would be within trust funds and state fund or something like that. So point being is yield generally drives what we do return-wise relative to the index. So I think we will likely have very modest underperformance for first quarter. It would not shock me, and perhaps a little bit beyond as we remain patient about taking those treasuries off and putting spread product on. Questions about fixed income?
Questions?
All right.
Hello everyone, I'll try to be short as well in the interest of time. Non-core fixed income. Our asset class that includes our three high yield managers. Non-core fixed income, the high yield managers had a very good calendar year return, close to 14%, as you see there. Again, I feel like kind of a broken record on this asset class because it's been the same thing for so long, where they're outperforming the investment grade corporates as well as treasuries and such, generating good returns. Yield spreads for high yield are still fairly tight. They tightened about 50 basis points during the quarter. For not a whole lot of value there, if you want to look at it that way. Also, because our managers, all three are defensive type strategies, they lag a bit in a strong market for high yield, so we've seen that again. That's continued for several quarters. So that continues, but we do expect that, when there is a blowout in yields at some point due to some market stress, that they will begin to outperform at that point in that type of environment. Any questions on high yield? Okay, let's move to domestic equity. Domestic equity, terrific returns, 30+% returns for the large cap domestic index for the calendar year. Small caps lagged. That was an upset to some of us, being that usually in an environment where you have huge returns like that for a calendar year, usually there's more ability for people to at least try and take some risk or be willing to take more risk in the small caps, and so the small caps would usually lead in a huge return year like that. But it wasn't the case because of some economic concerns and where we are in the cycle, and some of the China tariff pressures as well took people's risk-taking away a bit from the small caps. As far as our manager list, no changes there. The manager this time around, and unanticipated at this point, you recall that we had a fairly large change in the pool last April, and so we're letting things sit and cook and settle, or whatever you want to call it, at this point. Mixed results from our managers, we've heard that. Our returns for this asset class, if you look at our benchmark over the periods, they are disappointing. This year, this calendar year, I would say, even though we underperformed by about 40 basis points, I believe it was, 39, that's really actually very good performance in a year where you have such a tough market like that. It's really tough to keep pace with the market when you're seeing returns generated like that.
I don't understand why that is.
You get more risk taking in that space. You get more trading, and some of the higher valuation stocks typically outperform. One of the things we did see this year and are continuing to see is the FANG stocks are just doing really well. Those are the big tech stocks, and I just looked the other day. The big four are they consist of about 20% of the S&P 500 now. So kind of a narrow market right now, where if those stocks do well and you're an active manager and you don't own those stocks because you think they're expensive or too risky for you, you're not going to do well. It's just part of the characteristics of a narrow market. I would say that where we are with our pool, even though we have mixed results, still have confidence in the managers that we do have, so we're letting things work since we restructured, like I said. Our returns versus our peers are actually really good, as RBK said. A lot of that is because we carry a lot of passive in our portfolios, and of course we do feel like we picked been pretty darn good in our manager selection. But if you look at the overall pool, we're only about 23% in active large cap now. So when we did that change in April, we not only reduced those active managers in number, but we reduced our active management exposure in aggregate within that pool.
And I'm probably just misunderstanding, but on page 13, John said that under manager selection, the majority of the domestic equity underperformance was due to a small cap value manager, Von Nelson, right?
That was a quarter.
That's a quarter.
Oh, that's quarterly, because they obviously for the year out,
well for the year.
so that was just for the quarter.
Yeah.
Thanks.
Yeah. So with that said, like I said, I think that our the equity returns, even though not what we'd like to see versus the benchmark versus peers, we're doing quite well. And we're about as indexed as we can be right now without being completely indexed. So, I mean, it's the same old story I've been saying for domestic equities for so long, where active management is just struggling. And I think RBK would agree with that as well.
Especially in large cap space, yes.
Yeah, so it's really been tough, and, you know, hopefully, you know, you think that someday that would turn around because things go in cycles in this business, but so far it's been a really long down cycle for active management. International, let me get to that here. I kind of switched around my pages. I'm very pleased with international, other than the fact that international lagged by about 7% in the last year versus the U.S. So again, our decision to be heavy with the domestics and light with the international stocks versus our peers paid off. International did still have a good year, about 23% in total return. Emerging markets lagged a bit. We're doing really well with our benchmark comparisons, as you saw. Not as well versus our peers. And again, we've talked about this several times, but we have some apples and oranges comparisons within that peer group. One is that that peer group, a lot, or at least some of those peers do not have the same benchmark as we do. They can have like an EFA benchmark or an EFA plus benchmark, so they don't have as much EM exposure as us, as emerging market exposure, so that can throw off the peer group comparisons within international. Also, we do carry more passive in international than most other funds, I believe, and that is because it's considered that there's still more fertile ground for active management in the international space versus domestic. So most plans carry more passive than us, but you know, I think it's appropriate where we're at right now for the amount of passive that we do have in there. If you recall, we restructured this pool about 4 or 5 years ago, and we did that with replacing some managers that we have in there now that have done well for us. And so we're kind of waiting for that. That's how we ended up being so passive back then, is we wanted to see how these managers did, and they've done as a group quite well for us. In fact, if you look at the calendar year returns, they all outperformed their benchmarks except for one who slightly underperformed. So that's really exceptional performance from a manager selection standpoint for the calendar year, and it gave us about 129 basis points in outperformance for the calendar year. Not much more to say other than on international, other than if you recall, we had in here for 3 or 4 quarters that we were interested in 130-30 international managers. We changed our mind on that. We just couldn't make it work from a logistic and operational standpoint. And we have those managers on our bench list, so to speak. We know them. But so if we do want to go that direction someday, we know who our 2 managers, our 2 favorites would be to this point. But we just can't make it work operationally at this point. It's just not worth it at this point. Any questions on any? I guess I can pause for domestics, but
No. Therapist or different, don't worry about it.
okay.
Yeah. All right, thank you.
Yep.
Skip?
Well, luckily we talked about STIP a lot yesterday.
We did.
This will be very quick. I guess the only thing I'd like to point out is the growth in STIP over the calendar year. A big part of that was the general fund growing. And if there aren't any questions, I'll hand it off to John.
Very
I'll
good.
get lunch. I know.
Just got sat down.
Kristen doesn't mind, she doesn't really love it, I force her to do it, so.
Very good job.
That's right. State fund, good performance here. Let's see, highlights. You know, we talked about a little bit with the policy, proposed policy changes that we're working towards. We have been somewhat reducing corporate bonds here a little bit because they've been so tight and moving them a little bit more into mortgages because we do have capacity within our current guidelines to do that. Outside of that, I guess I would only add that we did make a contribution to the new contribution to JP Morgan for real estate, which is kind of a replacement for UBS, who we've got a redemption in for, so we're kind of making that switch over time. Questions on state fund?
Still working with their board or their, everything's,
It's all good as long as we don't take down with it.
well, that's.
We covered that last night.
Right, we did cover that. I didn't realize you were gonna cover it. All right.
Trust fund, John's busy, so I'm gonna cover this one real quick as well. You know, we talked about it a lot yesterday with the proposed policy change there. Other than that, I think his only comments were he's been kind of, as things mature, also a little bit more on mortgages, probably a little bit more on shorter side stuff so that we have kind of that steady maturity wall coming in so that we can, you know, more easily reinvest in real estate as we work that out with Ethan and his teams to, you know, how we kind of pace that throughout.
John, does that sound right?
Yeah. Now he shows up.
Yeah.
Nice timing.
One question that sort of goes back to yesterday. So now we changed the policy, right? So now, what, will you send all the or the trustees, whatever you want to call them, a note to say we've done this? If you have any questions, let us know.
Probably won't send them a note across the board. We'll post it to the website. Obviously, we've got hopefully like a May, June meeting that we're going to have with them where we talk about what they can expect for their budget for the next fiscal year, and we'll kind of cover that. Here's what we're doing to help your returns over the longer term, so probably more in that.
My understanding, we sort of had a discussion yesterday, and in the language of limits, it was shall versus may. And we talked about it last night.
Yes.
And evidently, I mean, I think may would be better. Explain it, it's going to
Within the non-core fixed income, there was a section in there where I think we put shall in terms of how we added emerging market debt. So it was shall, I think it says shall be 10% of the maximum of 25% of non-core fixed income. We'll change that to may. We're not requiring ourselves to be 25% of the NFD.
Thank you.
All right. Anything else? John?
Looks good.
Okay. All right. Let's see. I think that's it, isn't it?
That's it, Mr. Chairman. We have domestic equities deep dive next meeting, benchmark deep dive next meeting. Look forward to seeing all of you. As you've heard from Ethan, real estate investment policy statement revision. We'll have a vote on the state fund investment policy statement. And then 2 staffing issues coming up. One, a director of fixed income and a fixed income analyst. And then we'll start discussions on the 2021 legislature and budgets.
And I think the only to-do thing was you guys
Board briefs.
indicated it in the board briefs you might, if applicable, we put the return data.
Yeah.
Or
So-
some sense of return
Yeah,
data.
absolutely.
No? All right, with that, we're adjourned. Thank you all.
Yep, we'll have better